as I said yesterday, the best piece of advice that I got from my boss at Benzinga was these conferences are a waste if you don't meet new people. So please, if you see me, come say hi. I'm Spencer. I'm at Benzinga. If you see a stranger sitting by himself or herself, say hi. That's the whole point here. And yeah, let's get started. Day 2 of FinTwit. Here we go. All right, let's bring up our first speaker on the stage right now. Let's get him on. Steve Place, founder of Investing with Options. Let's give Steve a hand.
All right, thanks, my dude. Good morning, everyone. For those of you watching this on a live stream, it is 9 in the morning in Las Vegas, so I trust everyone in the audience had a nice, relaxing evening, watched some TV, maybe read a book, got some herbal tea, ordered from room service. So we may be taking this a little bit slower today. We're going to be talking about something that I call wagging the dog, and it is how much of our movement in the equity markets is being driven by short-term options. And we're going to go through individual case studies. We're going to talk about the exact mechanics of this. For those of you who watched Chris's presentation yesterday, he did go through some of the gamma and vanna mechanics as it pertains to dealers and market makers. So we're going to get a little bit weird today. We're going to jump off the deep end. Do you guys know about options? You guys trade options? Okay, it's going to get weird, so just buckle up. First, we're going to talk a little bit about the markets. This is about how I feel right now. You all have seen The Big Short, right? The movie, and it's the one where they all go to the conference to talk about Bear Stearns, and then everyone's looking at their prices on their BlackBerry because that's how old that movie is. Bear Stearns is crashing. Kind of felt like that on Friday, right? It could have gotten weird if it closed at the lows and we're just all like, that was pretty nasty. With wagging the dog, because Jonah DM'd me on Twitter, he's like, dude, I don't even know what this is. What are you talking about? How is this pertaining to trading? So what we're going to start with is a love story, just a simple one. Boy meets girl. Now, I wasn't politically active around this time, mainly because I was in the 3rd grade. But there's some interesting history surrounding this story, because 1 month before this scandal broke, there was a movie that came out called Wag the Dog. It's got Hoffman and De Niro in it. The film centers on a spin doctor and Hollywood producer who fabricate a war in Albania to distract voters from a presidential sex scandal. This comes out a month before it breaks. And then what happens? The wagging the dog effect is basically where a government will induce a foreign policy intervention to distract against other things, right? So, Russia economically kind of looks like trash, so what do? The thing that we don't really want to talk about anymore with the Ukraine. But this is what happened. Lewinsky hit, we go into Kosovo, we go into Bosnia and Herzegovina, we bomb Iraq in 98, we bomb a chemical facility, I think in Libya. And so all that comes around where it's like, okay, is this a huge distraction, or are the mechanics just completely inverted on what they should do? And so we do see that in the market now. And so when we talk about this, a lot of the times people are like, wait a second, the options market is this big, and then the equity market is this big. And it's like, okay, we've got, what does that number say? About $40 trillion is probably a lot less in total market cap right now because, we've sold off pretty aggressively. So it's not about the size, it is about the liquidity. This is the bid-ask size on the S&P mini futures. And after 2020, liquidity basically doesn't exist. Okay, so if there's not a lot of liquidity in equity flows, in future flows, and then everyone starts piling into options, not just options, but weekly options, not just weekly options, but weekly options on Tesla, then things get weird. Then we're not seeing the normal dynamics of saying, oh, I should use an option to hedge or protect myself. It's now like, no, man, this sucker's going to the moon and we're going to break the market. So we're going to go into some case studies. We're going to look at our favorite meme stock. We're also going to look at Tesla and how that drove the AUG 2020 rally and how everything broke. So wagging the dog is when there is not enough liquidity in the primary asset to compensate for derivative-driven flows. This is happening more and more often. You can see the footprints a lot more in the markets as well. So we're going to start with this one. Everyone knows what this stock is. You don't even have to look at the ticker. You just look at this and you say, oh, there's a rocket ship, an ape, and there's a moon, right? So it's GameStop. The week before the move happened, was short calls in GameStop after that first parabolic move. I'd rather be lucky than good, and I'm glad that I got lucky because the next week it went on a tear. $30 to 450. Implied volatility, which is incredibly important here in our conversation, runs from 117 to 550%. And that's a 30-day basis. The weekly options, which we'll show some screenshots in a second, were much, much higher. So how does this dynamic work? I want to make sure I'm going into the right one here. Oh yeah, I called it. So this is January 23rd. Gamma squeeze is in effect. No one heard about gamma squeezes before this. They've been happening a little bit before this move. I think the big one before the GameStop move was actually Kodak. And you do have vanilla short squeezes a lot of the time. You know, the garbage small caps, you know, you get people trapped. And then you get that extra couple days move for a short covering rally. What we're seeing here is that plus throwing gas on the fire and the way that the options market can drive these kinds of moves. GameStop is the most extreme version of this. So we're going to talk about dealer flows. Chris did talk about this yesterday. We're going to talk about this in a very specific context, and we'll just look at how the dealers would be forced to buy shares into rallies, into IV spikes, and how everything just broke in GameStop. And then it followed on to AMC. What were some others? BlackBerry, Nokia, Kroger, I think, a grocery store. I remember buying max strike weekly calls on Kroger just because it started to move. And it was just that one weird week, right? So this is a screenshot of a call buy. This is the SPY May 22 402 call buy at 640. The market rallied a little bit on Friday, so this is a little bit higher. But if you go out and you're a retail trader and you say, okay, I think the market's going to go up. Okay, so you buy this call. There's always someone on the other side of the call, that call, so now they're going to be short a call. And this is what their risk profile looks like. Now, dealers don't like carrying a lot of risk. They don't like carrying a lot of what we call delta, all right? And that delta is basically sensitivity to the underlying price movement in the option. So if a dealer or a market maker, I guess they're interchangeable terms, they end up with a short exposure of -40. So what do? They go buy 40 shares of the S&P, or they have equivalents. So they can use the S&P futures market. They can use other options that they already have on their books. They can use dispersion where they can go out and buy Apple and Tesla and things like that to balance their books and things like other ways. But this is just a pure form of what we're going to talk about. So when they basically hedge off, they take an edge from the bid-ask spread because you're a retail call buyer, which means odds are you're buying on the ask and you're not working into your position at all. But that means they have no exposure right now. That exposure changes as a function of price. It changes as a function of changes in implied volatility, and it also changes as a function of time and some other weird things. So the price movement's gamma, and gamma is your delta sensitivity. So in this particular case, on both sides, if you see price movement against, you're either going to end up more net long or more net short, and then you have to adjust. Normally there's some form of delta band trading or, you know, some advanced stuff, and they've got the nerds with the spreadsheets that do all that stuff. You've also got changes in implied volatility, and this is known as VANA. We're going to look at VANA a little bit later with respect to the broad markets right now because we've seen multiple rallies driven by that one effect. You've also got time, and time's a really interesting one because if you have out-of-the-money options, you know, they're going to have a value of 0. It doesn't matter how much prices move at expiration, the value is still at 0, so you have no delta exposure, which means that your delta will always decay towards 0 going into expiration. And you got some other nerdy stuff in there, Volga and, you know, some other things like that. So what this shows us is the delta, the directional exposure for our fake market maker on this short call. Okay, remember they're short the call, but they also bought 40 shares of the S&P. So if the market rallies further, they're no longer delta neutral, they're now net short again, so they have to buy stock. Normally, it's contained. because what tends to happen is that the risk premium and the option premium available tends to be a little bit larger than what the actual market movement is. But when things get weird and volatility picks up, then things get a little bit more unstable and they're forced to cover a little bit more aggressively. And especially if you get a lot of retail Robinhood traders that all look at the Reddit forums at the same time and say, oh, I'm going to buy this one strike on this one option, on this one stock, and then it gets super concentrated and the imbalance forces a lot of covers. Now, what happens if volatility changes? Well, honestly, this is really hard to explain up here because Vanna is a weird creature. If it's an out of the money option, it behaves a little bit different than it's an in the money option. But what I'm going to show you basically is that if you're short a call and the Vanna changes, you're going to have to adjust again with shares. So we're going to see that with GameStop, where it wasn't just a gamma squeeze, it was also the changes in implied volatility, and the whole thing just got blown out of the water. And then you also have charm. All right, so when we look at GameStop, or when we look at Tesla, or when we look at some of these meme stocks that are very heavily traded with their options, you will see once they go parabolic, they're not sticking there. They're seeing some form of a round trip because all those dealers, which now have a bunch of inventory on their books in form of long shares, as time goes on, they're going to start selling those shares because they no longer need access to this. This mechanic has been playing out a little bit more aggressively over the past 2 years, but we have seen some form of it over the past decade, and we'll go into some other examples. So GameStop runs from $30 to $450. Implied volatility increases from 117 to 550%. During this move, I took screenshots of the weekly options change so we could see how this worked. Now, luckily, you guys can kind of read this, so we're gonna focus on the max strike, and this is 11:46 in the morning, and I want you to just focus on the January 200 call, and you can look at the left column, which is the implied volatility, and then the third column, which is the delta. All right, so for example, if you're a retail trader and you say, I'm gonna go buy the max strike weekly call at 200, that's an 18 delta option, which means the market maker goes and they're on the other side, which means they have to go buy 18 shares of GameStop to cover, okay? That's at 11:46. 11:56, we're post-halt. That delta has gone from 18 to 22, which means that the market maker has to buy 4 more shares. And you say, oh, that's not a big deal. But when you're dealing with 50,000 contracts traded at the same time, the aggregate required demand for these dealers is much, much more than the availability of shares to buy. Because you've got all these shorts that are like, oh shit, I got to cover my stock because I'm getting blown out. And so you've got that latent demand. And then this gets stacked on and it's throwing gas on a fire. 12:52, so this is an hour later. Max strike is at 23 delta. That third column right there shows you the volume. So you've seen 52,000 contracts traded. That's a lot. And that normally shouldn't happen. And this is the Robinhood dynamic that we saw. This is at 157, so we're coming close to the close. The implied volatility has gone from 535% to 552%. That delta has gone from 18 to 29. And so now there's 75,000 contracts traded on that one option. Now let's just say, I'm going to try and do math in my head while I'm talking live, so we'll see how this goes. Let's assume that all of those options were bought to open. All right, so let's just say it's 75,000 contracts with 18 delta, but 18 goes to 29. So that's about a 10 delta increase. So that means there's a latent demand of an extra 750,000 shares. If we're using a theoretical price, that's a little bit high, but it's close enough. And they have to buy that. And you say, okay, there's a lot of shares around. There's not a lot of shares around on the ask. We can talk about size, but we also want to talk about liquidity. And GameStop liquidity it didn't exist anymore because the whole market broke. This is at 253. That max strike has gone from, what did I just say, 29 to 42. And so the market makers are now forced to buy an additional about 10 deltas on that with 103,000 contracts traded on the weekly max strike calls. That's how GameStop broke. Next day, that afternoon, the max strike contract goes from 200 all the way up to 500. Implied volatility explodes to 832%. The delta on that max strike is 42. For those of you that know options, you know that an at-the-money option is about 50 delta, and then the further out of the money you go, the smaller the delta is. Okay, so you're seeing at the money at $320, and then what is that? $280 higher. We're still 42 delta. Okay, this is where the dealers finally wrangle control back from the retail. What do we call them? Apes. We'll call them retail apes. So after that, now that implied volatility is 832%, all the dynamics work the exact opposite way. Because once implied volatility goes down, that delta goes from 42, let's just say, to 30, which means the market makers now have to sell shares. So as implied volatility falls, the stock's going to take a big dump. As time goes on, because these have 2 days to expiration, if the stock goes from 42 to 0. We saw on that 200 strike, 100,000 contracts traded. There were a lot more, tens of thousands just in this chain. And so that's how you get that move to the other side. I'm going to nerd out really quick with physics. When we talk about normal physics, let's just say a weight on a string or a pendulum, we have nice, simple math equations that give us the answer to those. Physics breaks down when things either get really small or really stinking fast. And that's basically what happened here. All the pricing models just completely broke. And now we've entered effectively a new vol regime with these kinds of things popping off a lot more. This was my terrible take. This was before GameStop ran, about 2 days before it hit, where I said, GameStop's done. And I went through the exact Vanna mechanics. Okay, now timing matters, because I think GameStop was trading at $70 when I made this YouTube video, and then it ran to whatever we just saw, $500, whatever it was. This is the first time I got death threats on social media too, so you can't get access to this video. But that's basically what happened. We go from an implied vol of 800% to 665%. The delta goes from 40 or whatever it was down to 12. Market makers now have to just unload a ton of inventory onto the market, and that's how you get a crash in GameStop. You say, oh, it's GameStop, right? Not a big deal. It's just a one-off event. No, it gets weirder, and it's been happening with a lot more frequency. Tesla is the poster child for this. So GameStop was kind of a one-off event. There were some echo gamma squeezes that we saw in GameStop and AMC and Tilray and all those others, but the mechanic's still there. Now, GameStop and all those meme stocks do not directly affect the broad-based indices. At least they shouldn't. They do sometimes, but up until Facebook took a giant dump this year. So at the beginning of the year, we had Facebook, Amazon, Apple, Google, Microsoft, and Tesla accounting for 50% of the weighting in the NASDAQ 100. Just those 6 stocks were moving the entire market, and they still are. It was about 35% weighting for the S&P 500. Okay, so this is where it gets really interesting. Anytime you have seen a strong move in Tesla to the upside, those parabolic spikes have been driven by those option flows. How do we know this? Because the implied volatility has been running with it. In a normal kind of equity market, implied volatility, the demand for options, is when the market's taking a dump. Because people are like, oh shit, I got to protect myself. And they say, I'm going to go buy some puts, I'm going to hedge. And normally what we'll see is call options will get sold. And they'll say, oh, I want to reduce my directional exposure and gain some income, so they go sell calls. This is retail saying, you know what, Tesla is way too expensive. It's a $1,000 stock. Obviously, this is post-split prices. So we're going to go out and buy a bunch of calls, and that's how you get that jam higher. Because Tesla is weighted so heavily in the NASDAQ, we saw the gamma squeeze mechanics bleed into the broad markets. And this was in August 2020. Remember, liquidity still sucks. It definitely sucked in 2020. And if you were a bull, that was great, because liquidity and the lack of it runs both ways. That's how last week we saw a 4% rally and a 4% sell-off in the S&P. Vol begets vol, right? So what we saw here was Tesla announced a split, and everyone said, oh, I'm going to go buy calls into that split, right? And that in and of itself led to a strong move higher in Tesla, the same kind of gamma and Vanna dynamics that we just talked about. But here's where it gets fun. Tesla degenerate call buys leads to dealers getting short, and dealers can also, they can go buy Tesla shares. They can try and rebalance with Tesla calls or some Tesla sold puts. But because of the weighting of Tesla, they can go buy NASDAQ Delta, or they can go buy NASDAQ Gamma, and they can rebalance by picking up long vol, long upside vol in the NASDAQ. And that is how you get this run in Aug 2020 in the NASDAQ, where we had that massive move higher and implied volatility ran with it. We got a 40% implied volatility reading into a parabolic spike. That is not how the markets are supposed to operate, but it is in our new liquidity and vol regime. So what happens here, and this is really interesting because we've got a couple splits coming up with Amazon and Google as well. Tesla runs into that earnings of the split event. Tesla splits. What happens to stocks after they split? We're no longer seeing a 100-point day. We're seeing a 60-point day, which means on a percentage basis, volatility is still the same. But when it comes to the options market, you don't have that out-of-the-money gambling that goes on. So realized and implied volatility on Tesla gets absolutely crushed off in both price and vol. That's not normally how the markets work. Normally, when the market sells off, people say, oh shit, I got to go buy some puts, and then implied volatility rises, and then it gets completely inverted. Call this one too. This was a video on YouTube, at the end of August, the coming rug pull in tech, going over these exact gamma and vanna dynamics. Okay, so this is not hindsight. This is the way I have been approaching the market and how I've been trading it since then. We're going to go down the rabbit hole even further. Right, so GameStop was directly related to its own stock. We just talked about Tesla and how Tesla bled into the broad-based indices, which led to that squeeze higher. Now we're going to go into vol markets. This is how it's supposed to normally operate. You're supposed to see traders who say, okay, I'm scared about market downside. I'm going to go buy some puts. When you buy options, that raises the demand and it raises the implied volatility. One way to look at implied volatility is spot VIX. Remember, you can't trade spot VIX. It's impossible. It's a statistic. All right. But there are things linked to it with respect to volatility futures and VIX options. And then it goes into volatility exchange traded products. So that's the normal way it's supposed to work. S&P supply and demand is supposed to drive spot VIX, which influences VIX futures, which then drive the prices of volatility exchange traded products. So let's talk about XIV. Anyone trade XIV back in 2017? No one remembers that? No one wants to talk about it, right? Yeah. Oh, it was a train wreck. So what happened here, same kind of thing. Retail demand was so large relative to the liquidity in the market that the tail started to wag the dog instead of the other way around. So we got it inverted. I don't have a live price of XIV because it doesn't exist anymore. It went to zero. I think there's still open lawsuits over it because in their prospectus, they said, hey, you know what? This shit can go to zero. And we're going to do redemptions if the VIX futures that we are currently short basically double. And I was in it. I was watching the whole thing unfold live after market because I knew that little phrase in it, but I said, oh, wait a second. The volatility futures market closed. We didn't hit that threshold, so this is a decent buy the dip scenario. Boy, was I wrong. This is SVXY. This is also another short volatility product. At the time, it was trading, this is post-reverse split prices, but it had run in 2017 from $250 to $500. Now, the whole thing runs in reverse. Everyone and their mother thinks XIV is a wonderful trading instrument. And it is. But it got too crowded. To the point that the custodian of XIV, which I think is Credit Suisse, not Barclays, it was Credit Suisse, I'm pretty sure. They were shorting so many VIX futures that it dampened the actual volatility in the markets. Not just implied volatility, but the actual daily moves, because the dealers, anytime we would get some kind of volatility, they would just be rebalancing a little bit more aggressively. So that end of year rally in 2017, where it was just this grind higher and then we just went this parabolic straight shot up, kind of looked like how Tesla ran except instead of seeing implied volatility go up, it was at the floor. We saw a VIX around 10. Weekly options were trading in single-digit vol as well. And that's how Volmageddon happens. So this is, this is SVXY as well. And the whole thing gets, I'm sorry, that's the S&P. Yeah, I really need my glasses on for this. That February 2018 move was directly driven by XIV failing. Again, this shouldn't happen, right? The S&P is supposed to be this massive market, and XIV is supposed to be this tiny little weird nuanced trading instrument. But because the demand was so high relative to the liquidity available in the market, it drove the S&P. And then that's how we see a crash. I'm talking way too fast. I may run out of slides, so I'm going to go through some case studies. I think I still got them on here. Cool. Now we're going to talk about Vanna squeezes because this is going on right now. We have seen, you know, it's fair to say this is a bear market. Bear market rallies tend to be the most vicious. Not just because it's a lot of people buying, it's also because there's just not a lot of liquidity on the ask, and so prices just move massively to the upside, just like they do on the downside. It's how we get a 4% rally last week, followed by a 4% sell-off. But what we have been seeing recently is the dynamics in the VIX market where we will run into an event, and it's almost like an earnings type event, right? CPI is one of the big drivers, and then the other is the Fed and their interest rate decisions and how they're going to hike. What are we sitting at? An expected Fed fund futures rate of 3% going into November. Good luck. The Vanna squeeze happens when the event risk starts to come out and then the VIX starts to drop. I'm going to try and explain this as best I can right now, just off the top of my head. If you own a put and the volatility drops, the delta drops, which causes dealers to buy, let's just say S&P 500 futures, or they buy the spiders, or they find some way to reduce their short exposure in the market, which can lead to massive rallies in equities. Again, S&P liquidity is kind of trash. So when you have a VIX that goes from 36 down to 20, you're going to get a 10% rally in the markets. Now here's my conspiracy theory on this. Does anyone trade VXX actively at all? You guys know what VXX is? A rough idea? It's a long volatility ETP. I guess it's an ETN. Where that yellow box is, that's when Barclays suspended sales of new VXX issuance, which means that Barclays was no longer in the volatility markets buying VIX futures. That demand disappeared. If demand goes away, what happens to price? Price goes down. So this is not spot VIX. This is the VIX futures. And it tanked. It ran from 32 all the way down to 22. Now, we had just come off the back of a Fed meeting. They hiked 50. They said we're going to hike 50 again and again and again and so on. But what then happened, and my guess, is that the magnitude of the rally that we saw was heightened because we no longer had that tail wagging mechanic where a bunch of retail traders who were concerned about further downside price action were buying a bunch of VXX. And that's how you get this massive market rally. It's really weird right now, though, because we have seen, just like I'm talking this week, the market traded at lows. It's coming in. It's looking like it's about to fall off a cliff. The VIX hasn't freaking budged. And I got nothing for you on that. I can't explain that. The VIX has stayed very suppressed. There's also one more indicator called VIVIX, VVIX, which shows us the demand for VIX options. Anytime we've seen 145 this year has been a very reliable buy signal, and it's nowhere close to this right now. There's just no panic in the bull markets as this market is continuing to sell off. I've got an idea. If you guys remind me, it's kind of a harebrained conspiracy idea. We'll see how it goes. So we're going to go into some actual strategies because it's not just important to say, oh, look at these things and how they happen. It's like, okay, how can we profit from this? Now, if you have a good, profitable trading system, do not screw it up, from my advice. All right, we're going to be talking about some very advanced, very aggressive kinds of strategies for the short-term traders out there. you can take some of these concepts and apply them longer term as well. But we'll just go into it. When you see large rallies driven by calls, where implied volatility rises along with the market, a very good trade strategy is to do something called a put butterfly, specifically an out-of-the-money put butterfly. Basically, what I do is I look at a 20-day moving average, and when we're stretched over a certain amount, I say, okay, we're probably going to pull back in that 20-day. And so that's where I center my short strikes on my butterfly, and then I buy the wings, okay? Very advanced strategy. I'm sorry I don't have it on the slide, but that is a very good kind of trade to work with. That setup also works pretty well with some of these parabolic meme stocks. Obviously, GameStop's not running, but there are a lot of other small cap, what we would normally call low float names that for some reason now have options attached to them. And it is continuing to drive those kinds of gamma mechanics. And so there's a very good edge in single stock risk with that kind of strategy. Where do I want to go with this? Let's see. Yeah. Okay. The other kind of dynamic that we see is if you own a stock and the stock is going down, you say, well, that sucks. So I'm going to sell some calls against my position. By selling calls against your existing position, you reduce your overall basis in the trade. You reduce some of the directional exposure that you get. In exchange for that, you limit your upside risk. Basically upside risk, okay? So what tends to happen is that out-of-the-money call options become exceptionally cheap in oversold conditions. So what you can do is something called a callback spread. And this is where you go out and you sell an at-the-money call, and then you buy more out-of-the-money calls. And you can get it to the point where, if you're taking a shot to the long side, if the whole thing absolutely falls apart, you do not have a lot of risk to the downside. This is not a very aggressive bullish bet. It is a very aggressive upside volatility and upside skew bet. These things work out exceptionally well. This is one I just, I looked at it, I guess it was either Wednesday or Thursday. This is in Tesla. This is the buying the May 720 call, and I'm sorry, selling the May 720 call, buying 3x the May 750 calls where you get a debit of $1, which means if Tesla went to zero, you're out $100. Okay, if Tesla runs to 750, you're up 1,000. That's not bad risk reward. So you say, what's the catch? Well, the catch is if Tesla runs, let's just say to 750, well, you've lost $3,000 on your short option and you're not making any money on the 750 calls. So it does require a little bit more margin, and there is technically $3,000 of potential max risk baked into this. The trick is you don't hold these things for longer than you need to. These are not kinds of trades that you hold into options expiration. These are the things where either the stock has a hard lift or completely crashes, but you don't want it to chop around. The good news is, in this market, nothing chops, right? We're seeing these monster moves both to the upside and downside. There was some weird stuff last week where the overnight gap risk basically disappeared, so holding some of these overnight didn't really work. But overall, this is one of the better ways to get long exposure in the short term in a lot of these high beta stocks. Let's take a look at an example. This was the day before the Ukrainian invasion. I guess it's the Russian invasion of Ukraine. And so that was a monster gap down. It was capitulatory. We did see a hard reversal after that. But into that, I got long the market. Right? You say, oh, shit, that sucks. Right? But I was using those callback spreads. So what I did, we finished at the lows. A lot of the times when you finish aggressively at the lows, you're either going to see a hard bounce or the whole thing completely falls apart. It's very rare in my experience in this kind of market right now for us to trade close to the same price when we opened, when we had a very volatile event. So what I do, I buy some call back spreads. This is selling the 25 Feb 423 strike call at 397. And then buying 3 times as many, so it's on a ratio, the 430 call at $1.28. So I get a 13-cent credit. So if the S&P goes to zero, I collect a whopping $13. I've made dozens of dollars on this, right? The market gaps down hard. And I'm coming in, I'm like, oh, I'm just going to take a bath on these. But what happens is because the implied volatility cranks up so much that the at-the-money options that I sold just completely tanked. But the out-of-the-money options, they kept their bid just enough where it turned out to be a profitable trade. Because this isn't just a long trade. This isn't just a long delta trade. It's a long vol trade. Okay, so you can technically get long the market, see a monster gap down, and still find a way to make money in this kind of scenario. This is a fun one. I don't do these as much. This is more for the, more advanced vol traders. I should do these a lot more, but this is a good example, and it's a continuance of what we're talking about, where volatility is cranked, liquidity sucks, and so odds are we're going to continue to see monster moves both to the upside and downside, right? Buying an at-the-money straddle, so buying a call and a put at the money, it's okay, it works some of the time, but because we know that those out-of-the-money calls get so depressed in their value relative to what is possible on the upside, that's how you get a very profitable trade strategy. So what you can do, this is an example from, what was that date? The 12th. So that was a couple days ago. You could buy, as an example, the SPY 403 strike call. And that's about a 20 delta option. 20 delta, especially on a weekly option, tends to be very, very, very low odds. But we know that the volatility relative to the odds is a pretty good trade. But you don't want to take this completely to the long side. What if you get a strong move to the downside? So what you can do is you can do what the dealers do, except flipped. And you can short the S&P. You can short 20 shares of the spiders. So if the market completely crashes, right, you make a little bit of money. If you get some kind of a convex move to the upside, then you make a lot of money, okay? This one, because I did this live and the implied volatility was in the 30% range, it's not necessarily the best bet, but you can absolutely take this kind of trade, especially with futures markets. Now, there is the MES futures, the micros. I really wish those options were a little bit more liquid, but you can do the S&P mini futures too. Then you can trade them overnight. So if you see a strong overnight move, you can accumulate long exposure into a sell-off, and then you can take some profits into a rally. All right, this is a very, very powerful position right now. Long calls are better risk reward than long equity right now. So for those of you at Brian Shannon's talk yesterday, don't buy the freaking dip. I'm going to try and keep this a little PG rated. I don't view long calls as a bullish position purely. I view them as a long volatility position. So here's ARK. ARK's a train wreck right now. ARK is deeply oversold. ARK was trading at sub $40. It was testing the ranges, completely round tripped its entire rally, right? Buying this straight equity, that's a tough trade right now because it could just chop around for 6 months, and then you've lost opportunity cost by putting a ton of capital into an ETF that may take months to recover. But the calls tend to be very underpriced into oversold market conditions. And so you get much, much better risk reward and much better capital efficiency buying out of the money calls. 5 years ago, that would have been sacrilege for me to say, because I come from a net option selling, background. And you say, oh, all options expire worthless and all that garbage. But this is the kind of trade that's working out exceptionally well. Some of my better trades this year have come from, long out of the money calls into blood. Not because I'm super bullish on the market, but I know that the upside vol is currently underpriced, right? So let's just say you want to take a shot with Kathy again, come at the queen, best not miss. Let's say you go out and you buy a July 27 delta. So about 30 delta is where I like to sit. 30 delta is about 1 standard deviation. Normally what I'll do is I'll say, okay, where's that 30 delta? And where has the stock traded, or where could it go? So you look at this and you say the July 50 calls, right? The July 50 calls are currently sitting at 27 delta with a value of $1.70. I think they're worth $2.70 right now going to Friday's close. But if they go at the money, you know, they're going to be worth $5. So you could potentially go from $1.70 to $5. That's not bad. And then you look at the chart and say, okay, where was $50? We were at $50 like 5 days ago. All right, the odds of us at least touching that level is much, much higher than what the options are currently pricing in. So that makes long calls potentially a viable candidate. Okay, so it's not saying, oh, I'm completely bullish and I'm bought in on Kathy and her ARK funds. It's saying, you know what, the liquidity sucks. Again, both to the downside and upside. Upside volatility is also commensurate with downside volatility. That's how we get a 4% rally and a 4% sell-off back to back. And so you can take a shot to the long side with out-of-the-money calls. So we're towards the end. I've got some other case studies that I want to talk about really quick, and then I'm going to open it up for questions. There are some other tail-wagging risks that I'm starting to see. So this is the most recent one in crypto. This is UST. Anyone in crypto markets? Poor guys, I'm so sorry. UST is tied with Luna. Luna went to 0. All right, I was even trying to be cute. I'm looking at a volume-weighted average price against the swing lows from a couple years ago. That didn't hold at all. It's trading sub-penny. It was trading at what was that, $200? $200 about a month ago. Luna did not sell off because a lot of people were selling Luna. Luna sold off because they had to hyperinflate their crypto because their stable coin broke. And so we now have this new convex relationship, a tail-wagging relationship in some of these crypto stable coins and how they can directly affect that market. And then you say, oh, crypto doesn't matter for tech stocks. Well, it might. You know, it is in that risk bucket where the market and the economy is falling apart. I thought Bitcoin was supposed to rally into economic uncertainty. No, it's tied to liquidity in tech stocks right now. And so it could be a tail-wagging scenario where if crypto gets really weird, where's the source of liquidity going to come for all these people who were leveraged long in crypto? They're going to have to sell some of their stake in, let's just say, tech stocks. This is, I think, Tether right now. This is Tether indexed against USDC. Tether's the big one in crypto. And, you know, the story for it has been around for years where we don't know the capital backing for Tether and things could get really weird with that. So we'll see how that emergent tail wagging comes through as well. So to recap everything, this isn't going away. If you're an options trader, you should really be enjoying this. If you say, oh, I don't trade options, well, you do trade options. You just don't know it, right? If you buy the S&P, you are getting some kind of options exposure there. I no longer like saying, is it a bull or bear market? Because we can have bull markets where the liquidity sucks. We can have bear markets where liquidity starts coming back in. So I view things in terms of volatility and liquidity, and how you structure your risk in the options market should be driven by a lot of that as well, not just whether you think the market's going to go up or down. I really do think that we're transitioning. We could start to transition here. And it's not necessarily a bottom call in the market, it's a liquidity call. Where because stocks are bad, right? Stocks look like trash. Bonds, bro, the 10-year, that's the worst sell-off we've seen, right? So we are probably seeing stuff in the bond market directly affecting stocks. And now that we're at 3% on the 10-year and we're coming into some major levels, if bonds start to stabilize, that'll be the first signs of saying, hey, maybe liquidity will start to return a little bit more in the stock market. There's also one more, and this is the tinfoil hat side of things. We've got some splits coming up in the NASDAQ. We've got Amazon and it's Google, right? Google splitting. So these stocks, which were, $2,000 stocks, are now going to be $200 stocks. And the same mechanics that we talked about earlier on Tesla and Intuit split will also affect Amazon and Google. Amazon and Google are massive relative to the NASDAQ. So if their volatility, both realized and implied, starts to come down, it's going to bleed into the NASDAQ. And that could put more liquidity in. And it could mean that volatility starts to go down, which means that the VIX can no longer justify a reading of 30%. So we could get a tail wagging scenario where we could just bottom because more liquidity is introduced in the market and has nothing to do with the economy. Right? That's the tinfoil hat stuff, and that's something that I'm looking out for. So into these splits, watch VXN. That's the VIX for the NASDAQ. And if that really starts to come down, that's going to start to give us a little bit more of a sign that things are starting to improve a little bit going into the summer. What are some of the other ones? Yeah, the post-split thing. There's one more tail wagging scenario that I think could be driving a lot of this right now, and it's risk parity. Risk parity is where you are long stocks and you're long bonds, right? And in a normal market, if stocks are selling off, then bonds are defensive. They haven't been particularly defensive this year. And this, if you look at the performance of risk parity right now, it's the worst we've seen in decades. And so I think a lot of the vol that has come into the equity markets, and we're not talking about tech growth stocks, we're just talking about everything else, could be driven by that, which is why, we're not just option traders right now, we're bond traders. If you're buying stocks, you're taking a bond position right now as well. We'll get to the pitch here in a little bit. Are there any questions with this? I know we covered a lot of stuff, so we went down the rabbit hole. Yeah, go ahead. Okay. The question was, for those viewing at home, when we're talking about short-term options, what duration are we talking about? We started to see this happen. When did weeklies get introduced? Somewhere around 2011. We had the CBOE penny pilot program came in, and then the weekly options were introduced. So I'm talking about sub 10 days to expiration. More and more options trading is continuing to concentrate into short-term options. Who was talking? Andy at the CBOE was talking about this, where they now have dailies. And they actually just launched them. We had Tuesdays come out last week. Tuesday expiration. Like, they don't expire on a Friday, they expire on a Tuesday. We've got Thursdays that just came out, right? We call them cracks, right? They're crack options because when they move, they move. And if you're pretty good at timing, these can get to a very, very low value. And then once you get that hard reversion, you're looking at a 10x trade. So more of the volume is concentrating into these short-term options, and short-term options have a lot more gamma sensitivity than longer-term options do as well. Any other questions with this? Okay. So gamma, he's asking, what did I mean by that? If you think about a call option at expiration, if it's out of the money, it has a delta of 0. If it's in the money, it has a delta of 100. The gamma is your sensitivity to delta changes. So as long as that option's out of the money, there's no change. At expiration, if it goes from out of the money to in the money, you go from a delta of 0 to 100. So that's that's technically infinite gamma. For the nerds out there, it's a Dirac function. Okay. So we have the bell curve in options pricing, and as time goes on, that bell curve continues to compress, and that's your gamma sensitivity. Okay. Any other questions with this? Okay, so back in April, May 2020, the market had bottomed. I was pretty confident that we weren't going to retest the lows, not because I was super bullish on the market, but it was a liquidity call. And I knew that I wanted to find the best stocks that were going to be the first out of it. So I developed a scanner, and the scanner is a weekly Bollinger Band. It's just pretty easy. But I want to give you a list of names. This was May 2020. If you had this list, just think about the possibilities, and you should know some of these. NVIDIA, Spotify, Etsy, Shopify, Wayfair, DocuSign, Chegg, Twilio, Netflix, Zscaler, PayPal, Moderna, Novavax. If you had those names in May 2020, you probably had a pretty good 2020, right? So that's what I'm looking to do right now. I'm constantly scanning for the first names out, and my main focus is on a weekly Bollinger Band. Right now, we're seeing refiners, Valero, Phillips, We're seeing like Kellogg, super defensive names. So we're not there yet. But if we are close to a market bottom, you need to find those first leading stocks. So here's the pitch. I run a brand new service. This launched 2 weeks ago. This is investorinvasion.com. We're looking for that aggressive capital flow going in. And every Tuesday at noon, I go through my screener on live video and I talk about the setups, and we look at trade setups, and we send out some trade alerts and things like that. If you go to investorinvasion.com/MS, that's going to be a short code to an order form. It's $10 a month to come and trade with me and do that live video every Tuesday. It's $9.95 a month, something like that. So yeah. Yeah, like Morgan Stanley, MS. Yeah, so that's the pitch for you to come and work with me. That's going to be a lot more momentum style trading and not a lot of the super advanced rabbit hole stuff that we talked about today. Any more questions before we wrap this up? I know we covered a lot of stuff. I know it got weird. I know it was super advanced. I saw some eyes glazing over and things like that and saying, oh. But you got to know about this stuff right now because it's what's driving the markets. These are the flows, and until liquidity improves in stocks, we're all options traders. So, okay, cool. That's all I got. Thanks so much for coming out. Take care. Guess we got to do the photo shoot. It's a lot of cameras. All right. Thanks, dude.
All right. Let's give Steve another hand. Steve Place, everyone. All right. I'm going to introduce our next speaker. He is one of my personal favorite follows on Twitter, Christian Fromhertz, and I think he's a great trader. So, Christian Fromhertz, come on down, man. Let's give him a hand. You didn't get the intro music?
All right. Good morning, everybody. Thanks for joining me for today, for this morning. I really appreciate it. Also, great conference. Really wanted to just say thanks so much to Benzinga, Jonah. They did a great job, and I really hope that they continue with this tradition because it's been great. Really kind of putting, instead of just having Twitter addresses and so forth, it's really nice to meet people face to face, understand what they're trying to do. And really, sit back and having a few drinks and kind of enjoying the whole conference. So let me just bring up my information. All right. So just a little bit of background about myself. First of all, I'm the CEO and founder at Tribeca Trade Group. This is a company that I started roughly 5 years ago. One of the goals of which is to bring a trading edge to investors, right? Retail and institutional traders. Where I started my career was I was a financial advisor at Morgan Stanley. Anybody know what the DW stands for? Dean Witter, right? So I just haven't heard that name in a long time. Morgan Stanley did buy out Dean Witter, but just from that time period, I started my career right around 1999, right? So a very interesting time to get involved in the market. Things were going crazy. I did an internship in 1998 where I was doing things like going through prospectuses of IPOs and trying to help out the guys in the corner offices. The IPO market was going crazy. I remember reading a prospectus that was a company called Broadcast.com. Whose company is that? Mark Cuban. So that was the company that Mark Cuban made millions, billions of dollars with. Sold that company. He was right in the beginning of the dot-com phase, but it was an incredible time to get your feet wet in the market. I think we kind of know what happened. The market took off. To be a financial advisor starting off was just a very crazy time period. And then not too long after that, the Fed finally got in front of it. They pricked the bubble and the market started to decline. At that time, I switched gears. I decided I didn't really want to be that much in sales. I really wanted to get more into trading and less sales. And I decided to go back to school for a little bit. I went to Merrill Lynch. Now, if any of you knows institutional trading, they just don't have a seat for you to be an institutional trader. You really have to network. You have to kind of build at it. And after a couple of years, I was successful with that, started institutional trading. I worked on a desk called Delta One Trading. Right? If any of you have heard that term, Delta One Trading, it's one of those desks where they get into trouble from time to time. Right? There's been a couple situations where traders have lost $1 billion, $2 billion. Sometimes it doesn't come, to the public light for a little while. So it's a desk that is really handling a lot of money, right? That's futures trading. It is customized basket trading, right? Equity swaps, which you've heard various different groups get involved and have some trouble from time to time with equity swaps and the exposure and the leverage. We heard about that about a year ago. But it was a great place to work. And then, of course, there's ETF trading on a Delta One desk. So I did that from 2004 to about 2014. Awesome experience. Loved every bit about it. I traded through, of course, another bear market, which was, the 2008, 2009 market, which was really an interesting time as well to be trading and to be going through and surviving that type of market. So that's a little bit about my background, my trading style. Obviously, with ETFs that cover every area of the market, they're a great product, especially right now in this environment. Of course, you've got currencies moving, you've got the US dollar stronger, you've got rates moving, so you can access all these products. Of course, the commodity move that we've seen this year, ETFs is one of the easiest ways to kind of get exposure to these areas of the market very quickly. And then trend following style, right? How many of you are trend followers? Okay, great, awesome. We'll talk about that. Really, that's a style that I adopted over the years, more so once I left the institutional world, really to kind of understand and realize that we want to stick with trends for as long as they last. Trends can go on, it's very difficult to predict. I don't think anybody can really predict when a trend is going to stop. Right. What we're trying to do with that philosophy is not time market bottoms or tops, but basically stay with the whole trend. All right. So one of the things that I'm going to start with a chart, not to scare anybody, and that's not what I want to do. And this presentation, what I also want to do is take questions from you guys. I don't want to, I want this to be as interactive as possible. I want you guys to get as much information out of it. But so anybody know what this chart what name this is. So what we're looking at is 2006 to 2011, right? We got on the left side a nice move up, and then really I would call this pretty big deterioration, right? And this stock went all the way down to the single digits. Anybody want to guess what sector it's in? What? I can't hear, but no. Good guess though. Good guess. Go ahead. Not AAG, but in the sector. All right, so it's financials. Not Bank of America. So I'll give you the answer. Or any last guesses? Not Citi. All close guesses. Nope. It's Morgan Stanley. All right. So Morgan Stanley. So this is one of those situations where I remember exactly where I was when Morgan Stanley started to trade around like $6 or $7, right? And that's a situation where, again, not to scare anybody to say like, oh, this is what's happening in the markets and so forth. It's just one of those situations where sometimes you just don't realize how bad things can get. And I was thinking to myself when that day happened, wow, Morgan Stanley, are they really going to go under? Is this what we're dealing with? Luckily, the Fed, the Treasury got involved to kind of help the market, bail out the market. And we didn't really see that collapse of all the financials. But one of the questions that I get, and then we'll move on, we'll get into the subject matter, is why didn't you, that was such a great buying opportunity in 2009. Did you make fortunes from that market dip? Because that was the bottom, and then we started to move up and started to basically trend from there. No, I didn't, because at that time, and many of you may remember, there's a lot of companies that were going out of business. You just didn't know as an institutional trader or wherever you were working, if you were in financial services, if your company was going to make it, right? Every weekend you were worrying about, are we going to be the ones that are not going to make it through the weekend? So that happened for like a number of months. But the last thing that you were thinking about at that point was, hey, I'm going to start buying stocks in here because they're a great opportunity. It was really, you were thinking that you had a different priority list of things that you were much more worried about security. Because again, if you did happen to lose your job, there wasn't another bank at that time that was just going to scoop you up, right? So again, just different perspective, and going through these times in the market really kind of help you to get that experience to be like, hey, things can really get particularly bad before they get better. And I think just keeping that in mind right now, that we don't need to time the absolute bottom. Clearly, when I put that slide together in the middle of the week, the market hadn't bounced like it did Thursday and Friday, which is nice. But it was a different situation going back to the middle of the week. All right, so the MarketWebs. Let's get to the subject matter, right? So the MarketWebs, it's a technical system based on market profile, so volume at price, right? And this goes a little bit back to my institutional trading career too. But what we're using here is we're using volume, time, price to determine a technical roadmap which outlines significant support resistance that enables precise entry and exit points. So what we're doing here is we're really trying to take the emotion out of the equation, especially right now. The VIX has been hanging around 30 for a while. We're kind of under a higher stress situation. What we want to be able to do is make really good decisions. And that's what I use the technicals for, is to basically have some ideas, but really know where I'm going to be right or wrong. The technicals and the price is going to tell me where I'm right and wrong. We could use it with anything that has volume. So equities, futures, Forex. The system has been through a number of upgrades we've been developing. My colleague Web Begol is actually the creator of the MarketWebs, and we've been working together through the last years to make it better and better. Always making improvements once you have a trading system. You always want to capitalize and make things better, no matter what type of trading system that you're working on. Right? And they're really designed to help traders maintain a trend following discipline. All right, so we're going to get into, I don't really want to get into the nitty gritty of the definitions. We're going to talk about those, but I want to give some examples. So first of all, we'll talk about what a valuary is, what it means when price is inside a valuary versus when it's above or below. So let's get out of the PowerPoint presentation, because I am not a PowerPoint wizard. and most traders are not. All right, so we're looking at the S&P. We're looking at S&P futures. All right, so the value area is this shaded area, and because I'm on the weekly chart, and what's really nice with the MarketWebs is we're going to talk about multiple time frame analysis, right? Something called like the path of least resistance. That's what I want in my trading, right? I want to see price action get above, a resistance level and not have another resistance level right in front of it, right? So it's a lot of process of elimination when we go through and we're scanning for names, right? Many different programs allow you to do this. I use FinViz. That really allows me to go through charts very quickly, and just the process of elimination, right? A lot of times it's kind of like we're in Vegas, so I'm going to use this analogy. It's a little bit like playing poker, right? The really good poker players, they don't play every hand, right? They're folding, right? Until they've actually got something interesting. So that's what we do when we kind of scan through charts. So what we're looking at is the S&P, right? So this is the value area. This covers, and I'm going to highlight with my mouse over here. I hope you guys can see that. But the whole volume profile of what we experienced in 2021. All right. So when you look at that volume profile, it doesn't really give you, that much information. But when you start to look at a normal distribution around one standard deviation, you could really put some statistics which make it powerful to give you support and resistance, right? And if you look at how we started the year, kind of a little bit of an ominous sign was that the first bar for the week of this year, we started above value, right? And then very quickly thereafter, of course, each bar is for the week because we're on a weekly chart, but we started to break down into value, right? That triggered what's called the 80% rule, which means once you start a period above or below the value area and you break into the value area, there's actually an 80% chance that you're actually going to go through one side to the other. This was not a fun thing to kind of realize in the beginning of the year. Of course, you look at this and you say, oh, geez, could that actually happen? And what I was looking for was like, please, can we actually get back above value so that the 80% rule would not trigger? Unfortunately, that didn't happen. Next, if we just kind of go through and what we've gone through so far this year, I'm going to zoom in a little bit, but we got so close back in, I believe this was February, right? Towards the end of February, where we almost touched the bottom of value, but it was so close, and you could see it didn't count, right? So we almost got there, but there's no almost. So we actually rallied back a little bit, right? And I got excited just about towards the end of last week because the 80% rule was complete. Now, so that's out of the way. The next thing that we want to see, and this is always, as we go through charts, we always want to say, okay, this happened. What's the next scenario that could possibly take place? Well, you can kind of see we explored some lower levels, and then we basically closed right around that bottom of value. So it's going to be interesting. The next week is going to be very pivotal. Are buyers going to actually step in? Was it more short covering that we saw in some names towards the end of last week? Really, I think at this point, buyers have to kind of take the ball and run with it. If not, right? If we don't see this level, which is the 4071 level, then that's really going to go into my overall risk taking, right? We know that we're already technically in a downtrend, probably technically in a bear market. However they define bear markets, it's a bear market. But that 4070 level will go into my decision process for next week, right? Well, I'm mainly a swing trader, but I've also, really the two timeframes that I concentrate mostly on are probably the daily chart, and I'm also kind of a short-term swing trader, so I'm also looking a lot at the 1 hour chart. So it becomes a little bit of discovery process. Well, what are we seeing on the daily chart? Well, really interesting. I was listening to one of the presentations yesterday. Brian Shannon talked about volume weighted average price. That's also another indicator that looks at volume as well, right? And they're talking about, hey, if you anchor that price, you got a similar kind of bounce on a support level. Well, we're going to talk a little bit about, not only the value areas, but we're going to talk about something called vergent point of controls, which is a VPOC as we call for short. So you're going to hear me say VPOC quite a bit. Again, it's a vergent point of control. Well, what the hell does that mean? right? So that means that previous value areas that you could see on this chart, but they're not lit up, right? It's kind of a similar process like a gap. When there's a gap in price action, I know traders love gaps, right? Well, it's kind of a similar thing when price goes through a value area, right? Or if it doesn't go through a value area and the price doesn't go through what's called the point of control, where the majority of the volume happens in that previous period, what you're going to see is a red line drawn, right? So it almost is like price is leaving a gap there, right? It did not go through that high area of volume. Now, the market always remembers these types of things, and sometimes we'll go back and it will look for one of these areas where there was a lot of volume that happened previously, but price never returned to that. All right. That's also, like, going back to my institutional trading career, a lot of institutions would actually trade like this. They would say XYZ stock, right? I'm a buyer of 100,000 shares. Okay, stock moves, stock starts to work. They may tell their sales trader, hey, if it ever gets back to this price, I'm a buyer again, right? Because they may have a fundamental view, and they may say, hey, I really like that price. For whatever reason, if the market gets back to there, I'm going to load the boat. I'll buy more. All right. So this really kind of hit me, in terms of how I know institutions trade. But, we did come back and we were looking at this once we broke value for the month, right? Where could price go to, right? And you could see that we did, have a nice hammer bar right where there was a big, volume pocket where price had not returned before. Right. So the next, the next process in this step is to be like, okay, well, how much are we going to bounce here? Right. And I do also use the moving averages when we're trading like this, way below the value area. All right. So let's take a look at another one. Any questions, by the way, so far? Okay. Oops. All right, so let's look at NASDAQ for a minute. All right, NASDAQ's a little bit different. One of the things that we noticed here when we did have this so-called bear market rally, right, is that we stopped at the 200-day moving average, and we began to, trend down from here, right? Right around the Fed day, right, and this also happened in S&P, and this is how we can really kind of get into using the value areas to trade. Once we were below value, we actually tried, right, to get back into the value area for the month. We got a nice rejection there. And for those who have been shorting, that was a great place to basically reinitiate a short, right? And you could see what's happened there. Firm rejection, right where price needed to turn the corner. It didn't, right? And now we're kind of sitting here and we go right down to this next area of high volume, right? That has not been revisited. Right, and we've taken out the first one here. So, does this mean that we're gonna, go, definitely higher here? Well, we don't know yet. I mean, there's another virgin point of control that's sitting right there. What we have right now is probably, for the time being, what you probably heard, a lot of financial media say yesterday. We may have a tradable bottom, right? You can set your stop price, to that virgin point of control, and then make a decision if that doesn't hold. All right, so we covered the 80% rule. We covered the time periods. We covered a little bit about using multiple time frame analysis. We covered point of control, where the majority of volume has occurred based on the previous period. We talked about how it often acts as a magnet, just as we saw this last week. We were dropping. Price finds that particular area. We move down to it, and then we bounce from there. Right, that's a textbook virgin point of control, take out and bounce. We talked about, these are just definitions, top of value, bottom of value. A little bit more into the nitty gritty here. All right, and I want to talk a little bit. So again, multiple time frame analysis really helps me. Weekly chart, it's 1 year of activity. Daily chart is 1 month of activity. So every month, and here's what's really nice about using volume at price with the MarketWebs, right? There's nothing that we're doing in terms of subjective nature, right? Every new month, you get a new value area, you get a new resistance area, you get a new support level. We're not tinkering with that. We're not saying, okay, I need to expand this value area. All of that is automatic. We want to have our trading when we're using a trading system, right? It's going to be, of course, subject to your interpretation, but we don't want to have any control with meddling of the inputs or anything like that. 1 hour chart, we'll talk about those in just a second. Those are really interesting if you have a shorter time frame, because that value area will be for the week, right? And you'll really begin to kind of see the trend possibly change off of that 1 hour chart first, before you may see it in the daily and the weekly chart. And then, of course, the 5-minute chart for your day traders, that's 1 day of activity. All right, so let's talk about a couple of these things. So let's get into stocks. All right, so I really rely on relative strength. When I'm scanning, I'm looking for areas of market that are outperforming, right? And especially groups, right? So here's a good example. This was a trade that I was in earlier this year. If you've noticed, and some of these things, I don't have all the reasons behind, but if you looked at stocks like McKesson, right? Look at this chart, right? Doing completely something different than the overall market is doing. Now, is this a huge, outperformer? It's not a growth stock, but it's been a nice hiding place, and it's been trending. It's been working really well. If you go through some of these other cheap names in this particular group, now ABC had a little bit of an issue recently, but look at how well it held up. Right? Another one out of this group was one that I traded. We saw a lot of option activity. How many of you guys use option activity in your trading? Okay, so that's another tool in the toolbox. I use it. I basically use option activity as an idea generator. Also, we know that a lot of option flow and the gamma squeeze and so forth, definitely short-term momentum. So there is, in my opinion, some value with being able to read the tape, understanding where institutions are positioning themselves, and then basically using that and putting it on. What I like to do is put that into my own system and decide if that sets up well for me. So this is one where we saw a lot of option activity in here for Cardinal Health. And then it becomes in your trade, how the MarketWebs really helped me is, well, where am I, this isn't a name that I'm that familiar with. Where do I want to be taking my targets, right? Very important in this market, right? Because of course we don't have, an easy market where it's in a defined uptrend. It's gotten a lot more complicated as it has over the last than it was the last couple of years. So it's nice to have this roadmap to be like, hey, this is where I want to sell, because there was a lot of volume at these places, right? So you could look, and you actually have to go back pretty far to note that there was a lot of volume that had not been revisited right here. It gets even more interesting when we look at the weekly chart. Bang, price went right up to, a level that had not been revisited, right? And so again, this weekly chart, so each one of these value areas is based on a year, right? This was right in this particular period. There was no overlap between this value area to this value area. All right, so this point of control, we drew that forward. Again, it's all automatic. I'm not doing any of the drawing, but that was a great place for me to exit my trade. I didn't exit all of it because I like to let winners run. And I always have a little bit of, hey, maybe this can actually get up to previous highs. But I took off about 90% of the trade and left a trailing position, which then got stopped out. You could see, and then this is actually at looking at this weekly chart. It's kind of interesting, and this is what happens when you go through charts. Is you could see that at the price at this point is testing that top of value. So this is a great watch place for this stock. For now, it is stopped right at that support level, and that is 55. So 55, will be a great place to kind of say, hey, this could be a potential bounce area for the stock. A little bit too early because we don't have any confirmation that it's bounced, but for now, it's holding support. All right, a couple other examples. We're going to talk a little bit about some shorter time frames. All right, so this is AMD, and I'll use the PowerPoint. slide for this one. But, you know, the situation when names have earnings, right, and have had a decline going into the earnings, and then they begin to rally in the after hours market. Sometimes what we've seen, you know, over the last couple weeks, months, is that a name will rally in the after hour market, and then the market is just not strong enough. Sellers are coming in, and the name gives back the profits. So what I like to do is kind of after a name reports earnings, jump to the 5-minute, 1 hour, or 1 hour chart and see where we've got these virgin point of controls on your shorter time period to know where potentially the stock could run into. What we see sometimes is that a name will get to take out one of those virgin point of controls and just halt there for a little while, right? Won't do much. It's almost like it's thinking a little bit, right? Are buyers going to come in, right? Did they really like the earnings call? Are they going to buy into this move and kind of push it higher? In this case with AMD, I think it kind of stalled out here after that. It just wasn't powerful enough. And I think that's what we're seeing with a lot of, you know, this group of stocks. So if we look at AMD, right, it really hasn't done much since earnings. The good thing is it hasn't broken down either, right? So it's one of those names that, for me, I'm just kind of watching, right? I want to see if buyers are going to if they're going to bite, right? If the institutions are going to say, hey, this thing has gone through enough pain, or, you know, and if they're going to start accumulating the stock. Remember, the institutions are the ones who are really going to control this market in terms of whether they're going to continue to unload shares, or if they're going to actually, you know, start to find some of these names as attractive down here. So at this point, right, I want to look at the daily chart. Notice that it's doing okay comparatively to the overall, you know, tech group. It's holding in there. Am I convinced yet that this thing is going to start trending, right, and starting to kind of make some strides here? No, I'm not convinced. It's inside the value area. So again, it's kind of, you know, it's range bound. It's thinking, and it really needs for me to kind of get over that level, which is going to be 99.50, right? So then it becomes trade management. You know, I do like AMD. I like the company. So what I'm going to do is I'm going to place an alert, right? And I'm just going to set it and forget it. So 99.50, I don't really want to mess with this name while it's inside value, while it's in a range, right? I don't think anybody really wants to, you know, go get involved in names that are just range bound, right? If you're a person who's shorting right now, then what you would want to do is set your alert at the bottom of value, right? And you know, go after the name once it breaks value. But while it's kind of just digesting, you know, it's not a trade for me. Any questions? Okay, quiet bunch. All right, the Chinese internet group. What a hot group right now, right? Horrible group. But it doesn't mean that we can't monitor the group, right, and kind of see what's going on. I was just talking to somebody yesterday about the Chinese internet group, and I say, basically every week, I open up the laptop. Hey, what's going on the Chinese internet names? Nothing. Close the book for now, and you know, just continue to monitor, right? And that's really all that you could do right now, especially if you're a trend trader. You are not getting involved in this group right now. Every time it comes, so this is KWeb. I always start with the bigger picture. I always start with the sector ETF, and then I'll drill down to the individual names, looking for the outperformers or underperformers. This thing just cannot get above its 50-day moving average. Every time it comes up to the 50-day moving average, it fails. So I'll say, okay, you know, it's almost like, I'll use one of my bad jokes, but it's always like National Lampoon's Vacation, European Vacation. Look, kids, you know, Parliament, Big Ben, 50-day moving average. Nope, can't do it. So that's what I'm watching in this particular group. And I keep looking, right? Hey, PDD, can this thing actually get going, right? Because we'll see as well. Every time the Chinese internet groups move a little bit, call buyers start coming into this group, right? You hear about unusual option activity that we're buying KWeb. I look and I'm like, I'm not buying this thing. Maybe somebody knows. I would much rather be late than early with a group that's in a downtrend. We'll wait for it to happen. So PDD, I had the slide up earlier, but you could see 1 hour chart. It's only going up to those previous areas of high volume, and it's getting rejected, right? It's not doing anything yet. One positive, always look for the silver lining here, is that they are taking out these levels. So when it gets back up to there, maybe it won't stall. But for now, it's just another name to watch, another group to watch. I will say this to kind of take a little bit of a step back, right? I am kind of an optimist, and the market does go up over time. I think, having this conference at this time is just a great opportunity to say, okay, we might be in a really good situation. Maybe it's not tomorrow, maybe it's not next month, but we've almost like basically hit the reset button, right? And so many names have gone down so much that, again, it's still monitoring and watching and so forth and waiting for them. I like what Brian Shannon said yesterday too. He has the buy the dip, and he's got the the circle sign and the slash through it. I'm the same way, right? I want to let these names go down to where they want to go, and wait for them to basically start to base and start to turn up. Not in a rush at all, but I do think this nice reset button that we're getting is going to be a really good opportunity. And I think, what better of a time to have a financial conference, until you're getting, some really good setups, which might materialize in the next coming months, rather than everything at, 52-week highs. All right. So this was the NASDAQ chart, which I brought up earlier. So this is NASDAQ futures, right? Also looking back at the weekly chart, notice where this got to, right? When it had this little bit of a bear market rally, it got rejected right at the top of value. All right, so really interesting at this point, we're down to the bottom of value, and we've got a place to basically watch and see if buyers are going to come into that support. All right, a couple other examples. When I put this together, the VPOC had not been taken out, S&P. Anybody have any tickers that they want to go through? Like I said, I want to have this to be as interactive as possible, to go through some of your names that you're watching, and kind of take a look and see how they're basing. Roku. Okay. All right, so we'll do this the right way, which is starting with the weekly chart. All right. So, obviously back here, it kind of looks like a double top. So it has come down significantly. Where is this thing now? It's amazing to look at some of these prices. Topped out at $490, down to what is that, $97. Weekly chart, we've got a virgin point of control down here, but it's far away, right? Not something that I would worry about quite yet. You could see that we're basically back in here. We'll go over to the daily chart. So it's trying to, it's possibly trying to find a bottom in here. Notice where it's at, right at the bottom of value. So again, it's got a decision point. Using the moving averages too, you're going to have to get through the 50-day moving average. But from my context, what I would be doing is waiting till at least it could get into the May value area, which is call it $100, right? And if that happens, then you could possibly have a trade on your hands, looking for a move all the way through one side of the value area to the other. Remember, if that happens and it establishes itself firmly inside the value area, that will trigger the 80% rule, right? Where you could possibly see a move through the value area. All right, I had a couple stocks too that I was looking at. Just bizarre sometimes where you see relative strength. Going through charts the last couple days, looking through the beverage companies. I have no idea if anybody has a theory why the beverage companies are looking a little bit better. Now, Coca-Cola has been kind of the best in breed here. It's been holding up in a really tough market. The consumer staples, XLP, and the energy stocks, I believe, are the only two sectors. I didn't go through all my charts after the close yesterday. But I believe they're still the only two sectors that are above the 50-day moving average. So clearly Coca-Cola is one of those names in the consumer staples that's holding up pretty well. I like that it's come down in here to the bottom of value, right? And has been basing a little bit, starting to move back above. Now, it's going to have a little bit of, it's going to have that resistance to get through, which is going to be 66.40, but you know where at least that resistance is going to be. If you go through some of these other beverage names, this is where, no offense to Coca-Cola, because it is a slower mover, but Monster Beverage. I don't know what's going on here with Monster Beverage. What kind of alerted me to this name last week was it saw option, it saw option activity. I haven't seen option activity, call buyers and Monster Beverage, and I don't know when. Okay. Right. So there's definitely some overlap there, but I did see option flow in it. It wasn't like a humongous call buyer, but again, just brought my attention to look at something that just wasn't on my radar before. Monster Beverage. I took a position in this on Friday, in between the conference, and I just like that it spent some time consolidating. It's clearly more expensive than a Coca-Cola, and a little bit harder right now to go after some expensive names, but I'm willing to give it the benefit of a chance here. Now that it's above value, it's also above the 200-day moving average, and I do like when the moving averages line up with the value areas. And I know exactly where my stop's going to be, right? And we're not going to talk too much about risk management in this, but clearly, you want to be able to define every trade right now and knowing where it's going to work. So I have the idea, right? It's starting to move out of consolidation above value. Maybe it starts to trend a little bit. Maybe we can, hopefully, this would be my upside target, right? Which is an extension away from the value area. But if not, I know exactly where it's not going to work, right? I can put my stop price right at the top of value, and then I can go on to something else. I also thought if we look at the weekly chart here, right? So again, looking at the path of least resistance, right? Well, this thing actually closed back inside its value area for the year. So I find that significant as well, right? So I was like, okay, we're above value on the daily. We're back inside value on the weekly chart. There was a little bit of option activity last week. Boom, I'll give it a try, right? And that's basically just, that's what trading is, right? You like a technical setup. The group is strong, right? There's another one in here too. Fizz, right? That's the last time somebody brought up a chart of Fizz. But what happened on Friday? Like huge volume in this thing, right? If I cover it up the symbol, it looks like a print. Now I didn't buy this one, but I have to say I'm interested. You've got what looks kind of like an inverted head and shoulders. It's breaking out of the value area, out of a consolidation area, 200-day moving average. I've got my targets if I wanted to, right? I've got the extension away from the value area, and then ultimately maybe that VPOC up there. Just kind of interesting. And I probably would be more interested if I did cover up the symbol. And then Mr. Jonah's favorite, Celsius. Well, I was looking at this one too, right? In the same group. This one, little disappointing. You could see that intraday, the price got above the value area, but it did not close above value. So that's on the list of just, hey, I'll watch it. Again, the closing print always most important, especially if you're swing trading. But I would need to see a little bit more. But I give this name a lot of credit because it reported on one of the worst days, and it managed to rebound quite nicely. All right, so another name I'm watching. A couple relative strength names just to kind of throw at you, and then we could talk about any names that you guys want to go over. But I love the fact that this LNTH, which is a medical device name, and again, you kind of start with the overall ETF, right? These medical device group, such a disappointment. Was one of my favorite groups to trade, right? Have not been involved in this much, right? So being a trend follower, 200-day moving average, really was the point of, get out. Then of course this thing tried to kind of, for the whole medical device group, I was getting excited about this. Hey, maybe it can recapture its uptrend. Nope. Right. And, Disappointing, but I'm glad I'm not involved. So yes, so one of the names in this group, and it's a younger name, just acting much different, right? Had this one washout day, but look at where the washout day was. And I was in this trade, and I was like, man, it was not a fun day. The name just, completely no news, of course, but I stayed in it because it did hold the bottom of value, right? So I did give it the benefit of the doubt. It held up. And on Friday, it's almost back to where it was just a couple weeks ago. I did take a target in my trade. I added very lightly in here, right? Because right now it's just you have to be, you got to be taking targets, right? It's not the hey, I'm just gonna let it ride. Take a target. If it comes back and retests and kind of holds into that top of value, because I like the name fundamentally, had great earnings, 2 earning cycles in a row. This is one of those names that's like top of my list that I want to add on dips. But as long as the dips are into support and the support holds, if it really is going to push back more than that, I would be stopped out of the name. All right, another name just found by doing some scans, watching earnings gaps. Probably a name that many of you have never heard of. This is Super Microcomputer, right? Really nice. You would look at this chart and say, hey, the market must be doing really well, right? Look at this name, hold back, after earnings, 1 hour chart, did a great job this week. It was down a little bit, but it didn't break that support, didn't break the value area for the week. So I was impressed by that. I lightly added. Everything is lightly starter positions right now because I think it's just too dicey. But I do, definitely like to, participate, even though that the market has gotten much more difficult. But I love the fact that in a really tough market, this name is, held up very well. Again, decision would have been if this thing broke value, hey, maybe it kind of sits all the way back in here, and this is bad if you're holding a trade because the next area of support would be down in here and it would take out that whole earnings move. So far, so good. It wasn't a huge mover on Friday, but, that's okay. And it could also mean, if you look at some of the names that have been moving like crazy Thursday and Friday, maybe that has to do with short covering. Maybe there's just not a lot of shorts in this particular one. Also, one other note about this company. PE is like a 14, right? This market loves cheap right now, loves cheap names. All right. Any names? Any? Go ahead. Sure. Never heard of it. Kidding. All right. Weekly chart. So I was a Tesla shareholder. I want to get back into Tesla, but I have to let the technicals agree with my ideas. For me, I've got to see it go back above. Sorry, I can't read this. Was that 878? 878, right? A little bit disappointing when you look at this chart where you see kind of the lower high coming in, right? This did this before, so I would like to see it kind of start to base. And for now, I've got my alert set, and I'll be watching to see if it gets back above value on the weekly chart, which I think is most important. Daily chart, it's a mess. When a name goes down gets hit so hard like that, it could retrace, and maybe come back up to the 200-day moving average. I would probably be trimming at that point if you happen to add towards the end of last week. But the value area is so far above, it's very difficult to kind of get a grasp at that price action. I then begin to kind of look, for if you're looking for a day trade or a shorter term swing, what is the name doing on the 1 hour time frame? So if you notice, right, so this value area was for last week, right? We're going to get a new value area. So the first hurdle that I would look for Tesla, it looks like, if the market opened up here on Monday, it's probably going to open up right in the middle of the value area, which means like no signal whatsoever for me. What could be a signal is if it tests the bottom of value, I could try a trade versus support. If I came into Monday long, I would probably be looking to take a target at the top of value and then watching to see if it could break through that. Yep. The 80% rule is in play, right? So you can see that on the top left of your screen, right? We started the period, which was January, above value. It is broken back inside value. So there's an 80% chance that Tesla does go down to the bottom of value, which is 557, which is another reason why I'm out of the name right now. All right, so again, I like the company. I'm a big fan of the company. But just because I love the company, it doesn't mean I have to own the stock yet. I need the price action to prove it to me first. One other name that I was just going through too is this little group called the FANG stocks. I don't know if anybody's heard about them. But Google is kind of clinging to the bottom of value, right? To, what is that, 2259 is the level that I would really be paying attention to next week in Google. All right, one more, Apple. Right around the top of value. Probably need another weekly bar to see if this thing is going to really trigger the 80% rule. If it gets back above 150, you don't have to worry about that. I think I'm running out of time. Anybody have any one or two more symbols? Go ahead. Yeah, so I'm surprised I haven't talked about that group yet, but here's XLE. You know, I've been kind of hiding out in some of the energy names, trying to buy them on dips. I love the refiners. So I'm sticking with the trend, right? There's some risk. Obviously, we don't know what's going to happen with the Ukraine situation. The longer that goes on, I would assume that energy stocks are going to continue to do well. I really like the refiners and what's been going on in Valero. It's trading above value, so we're in price discovery. It's a good thing when things are trading above value. You're in price discovery, right? I'm in PSX, right, which also had really good earnings, right? Pulled back nicely in here to the 20-day moving average, a little bit to the top of value, and is trending. So I like this group. You know, I keep going through individual names, right? Somebody mentioned VET yesterday, right? That's a name that I'm watching, but I need to see it get back above 20. I think I'm out of time. But yes, you know, for a trend trading perspective, they're the strongest. They've been the strongest, and I'm certainly not going to predict when they, you know, break their trend. So that's it. I hope this was of use to you. Again, it's a different concept that most, you know, are looking at or haven't looked at before. I know that many people are starting to look at the volume profile. They hadn't before, but this really gives you a nice technical system that's reliable, clean cut, and it can't be manipulated, right? You can't say, oh, well, I'm going to do this or I'm going to do that, and I'm going to find a different support level. Nope, it is what it is, right? And as always, I always have trade ideas, but my technical system, the MarketWebs, tells me if I'm right or wrong, right? Always need to know. Price is the most important for me. And of course, it's great for bull and bear markets for going long and short. Any other last questions? Yeah, I mean, I want to see that. I want to see the buyers start to come back in, and when I say buyers, the institutions. So from when a name really starts to go down, you know, like we've seen names, all kinds of growth names really get hit. I think the next stage is that they have to start building a base and going sideways, right? If they start, you know, if it's more of you know, a reaction where they start to really kind of pull up a little bit hard, you know, harder than making that base from the lows, you know, then using that stop price of the recent low. Right? If you love that company, I think also legging into companies, but I try to be as patient as possible. And after steep declines like this, I would expect a lot of basing, right? And you could go through, I think the energy stocks, if you look at those for the last couple of years, they did the same thing. They all fell pretty hard. They based, and then they started to kind of, you know, retake their moving averages, 20-day moving average, 50-day moving average, that type of thing. Well, thank you guys very much. Appreciate the opportunity to meet you guys and to get in front of you guys. So thank you. last thing, sorry. If anybody wants to try out Trading Room, of course, has to be, someone here from the conference. But I am giving away free trials, for the first month. You could come check out how we use the value areas to trade on a daily specific, time frame, and get a little bit of a grasp for how we're using that in our risk taking. So Tribeca Trade Group, my handle is @CFromhertz. You can just private message me. Happy to give the first 5 people a look into the Tribeca Trade Group. Thank you.
All right. Christian has like a gajillion Twitter followers, and for very good reason, because he is posting incredible insights all the time. Also, is nice of him to join our show. He joins our Benzinga's midday show, Benzinga Live, every other week for a half hour. Christian, great job. All right, we're gonna go to our first fireside chat / panel-ish of the day. I am going to welcome to the stage now Gareth Mann, who is the founder and CEO of a company called AlphaStream, doing some very, very interesting things in terms of personalization of finance. So Gareth, come on up and let's get the other chair up here. That's good. Let's give him a hand, everyone. Actually, you know what? Oh, do me sorry, grab my cards right there on the table.
We've got the cue cards.
Yeah, exactly.
Genius.
Forgot the cue cards. Don't need the cue cards. We're gonna rip it.
Rip it.
Thank you very much. All right, Gareth, welcome to.
Thank you for having me.
2022.
It's good to be here.
You traveled a long way. Boston, pretty far.
Yeah.
All right.
The rest of the team came from London,
London.
and then we've got some guy from Austin out there.
Awesome. All right. You're the founder and CEO of AlphaStream.
Yep.
What is AlphaStream?
AlphaStream is a personalization AI that consumes a huge amount of content, financial trading signals, and personalizes it for you around your trading behaviors.
What does all that mean, though?
Okay, so we'll go back. So
Yeah.
I founded the company 3 years ago. I was in a hospital waiting for my wife to have a scan for our firstborn. And I was panicking about what to buy as in baby equipment. And Amazon did a great job of recommending me the right products that I needed. And when I was sitting there, I thought, hold on a second, this is crazy. As a day trader, I'm always getting burnt by missing a signal, a piece of data, wrong channel. I have a job. It's not my full-time job. How can I fix this problem? So that was the problem we went to fix. How do we control the content flow? Signals, nudges, emails, technical analysis, announcements, and how they prioritize to me so they're relevant to me and my behavior.
So you thought, wait a minute, I'm getting like ads for baby stuff because Amazon knows I'm about to have a baby. Why am I not getting signals that are that personalized in my trading?
So I went onto my trading platform. The news feed wasn't relevant to me.
Right.
The comms weren't relevant to me. Sometimes they were, so they felt following the herd. So I was like, okay, we can fix this. We can fix this. We can use data from other traders in the brokerage community and look at cohort analysis, and that could just. It was all based around well-being, if I'm honest. It was a feeling of when I was looking for my baby bath, for instance, the well-being that actually someone else had done some thinking to wrap it around me, and it was a really good. It was an interesting feeling that I felt with trading.
So talk about what this is in practice, and I'm wondering why no one else has done this sort of thing where you have all this content out there, and what if we just personalized it so you only got the content that we know you want to see? Why has no one else done that yet?
It's hard.
That's a good answer.
It's really hard. So it's not about just one content stream.
Okay.
So we call cohorts groups of traders.
Right.
So just for clearness, we supply our product into brokerages, into trading platforms. You wouldn't necessarily know where we exist. You would only know if you looked at someone else's feed or content on the same platform. So the reason it's smart is that the platform understands. It's very easy to do e-commerce in comparison to complex financial products.
Sure.
It's also about sourcing the right content, right? It's just not one content stream. You've got multiple content sources. Benzinga being a great content source. You've got social media people using. You've got signal providers. There's some great presentations here about different types of signals charting, right? And so it's about the AI being able to understand what's relevant to Spencer at that time. And can this content wait until the trading day's over, or does he need to know now?
So let's talk about how I or anyone in this room or anybody watching online, how they would use or come across AlphaStream in their daily trading, whether or not they even know that they're using it?
So to go back to the kind of cohorts discussion, right? Let's talk about the expertise level, so the beginning levels, right? I lost my shirt plenty of times by not putting the stop loss on, and that behaviour of a new trader is common, not to put stop loss on, not to protect yourselves. So
Stop's important.
exactly. So, but behaviourally, it will know that user is relatively new to the platform, hasn't traded a lot, and needs that nudge. So the platform may reach out and say, look, here's some education on stop losses, right?
Okay.
Or here's some examples of things when things didn't go right before. So it's just constantly customizing the content.
So, like, for example, I'm using whatever brokerage X that I'm using. That's where I keep my money. That's where I trade. They can see that I like trading Tesla. I like buying the stock. I like buying options and selling options. And so they, using your software, if I'm getting this right, will say, oh, Spencer likes trading Tesla. We should start giving him more content all about Tesla.
Correct. And the financial instruments that surround Tesla.
Right.
So they don't make a conscious decision, right? Because it is literally one-to-one personalization.
Right.
So the brokerage doesn't sit there and make a decision for each individual. We just collect huge amounts of content. We collect their behaviors, and then per individual, we customize our experience for them.
So then they can say, hey, we noticed you like Tesla. You may also like this other really expensive stock, right?
Yeah. Kind of. It's actually bizarre. So go back to the kind of well-being, right? No one wants anyone to take their chips off the table using that phrase in Vegas, right? So it's about ensuring that your customers and the personalization is there to support you with your well-being, okay? So let's talk about that. So, like, if you don't day trade as your only career, right, it's your side hustle, how many times have people lost money by not being able to access information, right? And that you just get too many alerts, too much content, and you miss something. So the platform's designed to understand what's going to drive Spencer into a positive action to make you feel better.
So again, but maybe let's talk about how AlphaStream sort of fits into the equation here. So between the end trader and the brokerage, I mean, I guess, who are your customers, and how do you're just a tech layer on top? You integrate with the brokerages?
Yeah, we're a tech layer in between
Okay.
the broker's interface and the back end. We started 3 years ago. There's over 50 of us now. We've personalized over 1 billion interactions now across that. And as I said, you won't know we're there. You'll just have a better experience. You'll just have a feeling that actually that was really helpful information at the right time for me.
What's the benefit for the broker? Like, what do you tell them? How do you sell them on your idea? Because obviously we benefit because we get content that we want to see, just like we get ads that are relevant to us, right? But where's the benefit for the broker?
Two things, right? Engagement goes up on their platform. That's a really common thing.
Engagement goes up because
it's relevant. Because it's relevant, right? You go into the search box, you're searching for the instruments, and the instrument list of recommended instruments that are relevant to you are relevant to your peers and cohorts, right? So it's a really good way to share ideas. And the relevant content just increases lifetime value of people, right? It's smart. It can push out education. It can push the right nudges, right? So it supports people making fatal mistakes earlier on.
And then just talk about a little bit. I know you can't get too specific, but like in terms of your customers and where in the world you are right now. Are you in the US? You're overseas?
So we're literally expanding into the US
Okay.
now. So as we said, we kind of conquered Europe, and I mean, for the size of the business, we were just really blessed, right? We stumbled on the idea just at the right time when it was really meaningful in a really buoyant market. We hired our first body in the States 6-7 weeks ago. I've moved here personally, so the goal now is to get this into US trading platforms.
By the way, I would try to save questions at the end if we have time. If you have a question, try to keep in the back of your mind, and if we have time, we'll do some questions from the audience. But you mentioned that you were a trader. So can you talk about how you yourself have or would use AlphaStream?
So we dog food our own products internally. So we have our own content feeds, our own mobile apps, and we just feed ourselves our own data. So it's been very, very helpful. I've lost my shirt in the last 4 weeks, especially with my tech stocks when they dropped. My philosophy was always to buy what I use. That didn't pan out so well in the last 4 weeks. Very painful. But the anxiety levels, bizarrely, about having the content. I don't know about you guys, but when I panic and I'm like, do I get in and out of a trade? I just search. I go to Google. I look everywhere. And I've just found this kind of, the platform has evolved for me personally, because it knows so much about me, into this sort of symbiotic relationship of where it's pushing me content about the assets I hold that are relevant. Now, let's be really clear, it's not a signal engine, right? It will tell me this content from this signal provider is important to you because of your behavior, how you trade, the pans you use. But I found it's just less stressful. It really works well. It's just reassuring, right, that you've got something in the place that's curating stuff for you as an individual, not the herd.
It's funny because I would imagine if we were talking about any other industry and you're talking about personalization, there is that thought that everyone has, like, wait a minute, how much of my data do you really have? This feels kind of creepy. But what you're doing is giving relevant headlines that could end up make people money. So I would imagine there's a lot less reticence for traders because they want stuff that's relevant to them.
Yeah, totally, right? So if you personalize for marketing experiences, we did a test in the market, only 14% of people opted in. And when our platform goes live in broker, over 90% of people opt in. Because it's the value add. It's just not as headlines, as I say. It's analyst reports that maybe for you to read in the evening, right? It's something that's happening in the market that could affect an asset that you hold, right? So it's like a tool. Personalization is just another trading tool, just streamlining your experiences on the broker platform.
So we're talking all the content sources that are out there, all the signals, whatever, the middleman between them. You give it a little bit of personalization, and then it gets to me, and then I see what I want to, what I care about seeing.
Yeah, and
that's the idea.
And the reason to go through brokers, right? The reason we didn't make this a B2C business is because the reasons it's so powerful is that brokers have the funds to buy a huge amount of content and data sources and signals providers, right? Which would make it really expensive if you were doing it individually. But when you package this up with like 30 to 40 content providers, different signal providers, it becomes really powerful. So your interactions, if you like, are later with signal, price movement, news, headline, education, calms down when we know you're away. And then bizarrely, but by design, it can then, when you're off platform, it can move that data into email, into push notifications.
I would just imagine that your technology and the signals it generates get better the more someone uses it. So if I log into my brokerage X once a month, it's not going to be as insightful. I'm not going to get as much personalization as I would if I logged in once a day, for example, right?
Yeah. So two things. So you opt in with the part of T's and C's of a broker. You opt in, and your data, everyone's data, is collected as a cohort. It's all anonymized. There's no data sharing. So you will still see significant value because we'll be able to identify, even if you log in once a day and you trade and you're a value trader, you'll still have similar attributes behaviorally to other people on the platform.
So yeah, even though so I could see, there's other people that are around my age that have around my account size, maybe not age, but account size, and this is what they're trading.
Yeah, so it's not very common over here, but we're seeing it out in Europe. It's becoming more and more common for brokers to share what other people like you. Are they long? Are they short? What they're doing? What the volume today? Again, just as more insight, right? So get back on the platform, see what's available, and then we're finding that becomes really popular with the toolset.
Interesting. Yeah.
That becomes almost its own signal set on its own of people's behavior.
That's a whole other bag. That's a whole other bag, though. I mean, that's a whole other can of worms. I feel like if we're talking about.
I think it's about the core of our platform. Data privacy and security is key, right? So there's no way for anyone to get in and pull out personal details, actual individuals.
I mean, I got to say, we were talking yesterday, and it just seems like this is the most obvious thing in the world. Because we, even at Benzinga, we're like a fire hose of content, right? And the lift is on the end user to figure out what they care about, right? That's sort of the downside of having so much content is it can be a lot, and you need to sort through it all yourself. But you're basically saying, no, you don't have to sort through it yourself. We'll sort through it for you based on what you do.
Correct.
Which seems like it should already be a thing.
Yeah, and don't get me wrong, the concept of this tech has been in MarTech for ages. This isn't something that...
I mean, you see it for e-commerce all the time.
Yeah, you do. But where the tough bit comes is actually understanding the complexity of the financial instruments, right? So if we talk about the ARC ETF, our platform needs to know at any time what is actually in that ETF, for example, what the behavior... So it's just not like you're selling a single product, right? And that's the complexity, and I think that's why entrance to the market have been slow.
So as it stands, just to recap, as an end user, I do have to opt in, right?
Yep, everyone's
Everyone has to opt in. So if you're connected to whatever brokerage your customers are, they'll say, hey, do you want to use AlphaStream?
Know that they're normally, as I said, with that intermediate layer, they'll ask their customers, would you like us to personalize your experience and explain the value and the benefit? That's how we've discovered adoption has been so strong. Like, you explain the values.
Yeah.
This is the trade of your data, giving it to the broker. And don't forget, the brokers already know so much about you. So it's not like they don't already pretty much know everything about who you are.
Right.
They've identified it and KYC. Right. This is more now about just adding those additional behavioural elements to that pool of data and allowing you just to see the benefits.
And I'm just assuming the value for them is like, oh, they can send me more relevant headlines that will then let me make more trades that benefits their business. So it's
interesting. So
seems like it benefits. I'm trying to figure out what's the rub here.
The benefit to everyone is, right, so it's bizarre. Most of the brokers we talk to, they're not interested in getting people to trade more. They're interested in people just being better traders and just accessing their platform. Like nothing worse than not logging into your platform because you're scared about how much you've lost recently, right? So these kind of nudges, these kind of personalization aspects help just create stronger engagement, and stronger engagement always results in upside for everybody.
All right, Gareth Mann, founder and CEO of AlphaStream. We're up against the clock, and I know we have a break right now. So Gareth Mann, thank you so much for coming on. And any questions, don't be a stranger. Come say hi.
Yeah, I'll be in there.
He won't bite. And thank you very much, Gareth.
Appreciate it. Cheers. Cheers, well. Thank you.
All right, that is time. We are at our first break of the day. I'll see everyone next door.
So we're gonna go.
All right. Welcome back, everybody. We're going to get started with the next phase of the day, which is some sponsored pitches. So without further ado, let me introduce Carolyn Bao, who is head of marketing at MooMoo. So Carolyn, come on down. Let's give her a hand, everyone.
Thank you. Las Vegas, how are we doing? Woo! So first, have you all tried all-you-can-eat buffet yet? Have you had it before? Do we love all-you-can-eat? I do too. I've had one already since I came on Thursday. But what's the point? MooMoo is an all-you-can-eat professional-grade trading tool that if you don't yet have it, you are missing out. So let me tell you why. What do we mean by professional-grade trading tool? It is a professional tool created by the pros, for the pros. And when I say pros, I don't mean folks who trade at the floors in Wall Street wearing the vests. I don't really like the vests. But what I mean is we traders who take trading seriously as if it was a professional sport. And that's what we at MooMoo believe. We believe that the pros put their hearts and mind into this very serious activity, and they deserve the best tools and data possible. So thanking to our parent company who's been around for 10 years, we have perfected our set of tools. And our tools here I'm going to share with you today are going to really give you a nice surprise. If I didn't do that job, tell me afterwards. We can talk about all-you-can-eat buffet. The very first one, very important, is we understand for traders, it is critical for us to have the best data, best tools so that we can screen, analyze, compare the stocks so we can find out which one is our target to invest in. The second that's super critical, as we know, is we need to find out the best price action, and we need them to be executed quickly. And then the last one we have found out is trading can be a lonely sport. You might be the very one of the few in your inner circle that are doing trading seriously. So how do we make some of these pains go away? First and foremost, MooMoo is free. There's no catch. Use MooMoo, no account minimum. There's no fee when trading ETF, ADRs, or even options. The only thing we have for options is 65 cents per contract. That's it. The second thing that's also very important we mentioned, MooMoo will provide you the best tools possible. One slide doesn't capture it all, but we do probably one of the best technical analysis and technical charting tools on the planet, if I may say so. It is really helpful as a complementary set to the desktop versions tools that you may have, because MooMoo provides mobile and desktop in as good experience and as well as synchronized in real time. So you can do anything you want on your phone. When you go back to your MooMoo desktop version, you have all the level 2 data, you have the analysis and the charting tools. I mentioned about the charting tools. You can see VWAP and all the KDJ average, all of those things. If you want to draw your line, you want to jot down your own journal, you can do that. But what about financial fundamentals? Because obviously, as much as we do the short-term trading based on technical indicators, in a mid to long-term trading, you would still want to understand the financial fundamentals. We do that as well. We visualize financial trends across many years that you would need. You can filter, you can quickly see all the critical indicators as well. What about futuristic stuff? Because we're not here just to do the old school tools, because they come in a dozen easily. MooMoo actually uses AI to help you double check your own analysis. One of these that I'm showing here is AI-powered price prediction. It is called Similar Charts in the MooMoo app. The way how we do this is we look at all the price trends across all the stocks, the entire history. And we see, using big data, to see what price patterns are forming for the one that you're looking at, and what's the price trend might look like for the next day, given this pattern. We do it for you. It's automatic. It's free. The last one is we also have a very engaged community, probably one of the biggest trading communities out there, again, on the planet. We have 18 million users across the MooMoo's extended family of apps. And in this community, you can follow, you can post, you can share your own profit and loss, you can find inspiration, you can connect, you can direct message other traders. And definitely check us out. We have prepared a very exclusive offer for our FinTwit attendees today. Come and check out our booth or scan the QR code, get your MooMoo app today, and make sure you take home this completely free stock of Celsius. And this is, by the way, Jonah's pick. And also don't forget, by 3:30 p.m. today at our booth, we're going to give away $100 credit for the Aria Casino. Hit us up. All you can eat.
There we go. All right. Thank you very much, Carolyn. Let's move things right along here. We bring on our next speaker, Mr. Greg King, founder and CEO of Osprey Funds, doing some very interesting stuff in bringing crypto to the masses and making it easier for people to buy and sell crypto in security form. So, Greg King, Osprey Funds, take it away.
Thanks, Spencer. Morning, everybody. So let me see by a show of hands, how many of you guys trade crypto? Okay. How many of you, that's quite a few people actually, more than I expected. How many hate crypto? Wish it would go away. Do we have any haters? There's one guy. Okay. There's always a couple of haters. That's all right. But this is a trading conference, right? So you guys like to trade stuff, and presumably you'd rather trade things that move rather than things that kind of just sputter along, right? So guess what? Crypto moves. And that's one of the things that's exciting about it. But let me tell you briefly about Osprey Funds, and then we can have a little bit of Q&A, because typically there's a lot of questions around crypto. So we set up Osprey Funds several years ago. My background is creating ETFs. I've launched over 100 of those for lots of different firms, Barclays, Credit Suisse, Velocity Shares, etc. But in 2013, I bought some Bitcoin. Somebody said, don't invest more than you want to lose or can afford to lose. And back then I said, all right, I'll speculate with $1,000 and bought 3 Bitcoin because I have 3 kids and I figured they could each have one. And that sort of got me into it. When you establish a position, you tend to pay more attention. So I paid attention, and my day job was building ETFs. My hobby was speculation. And I didn't think the two had anything to do with each other until a few years later, when it became clear that an ETF was starting to potentially be possible. I'll spare you a lot of gory detail. You've probably read about it in the press, but still to this day, the SEC is not a fan of the idea of a Bitcoin ETF or any other crypto ETF. So what we have are these OTC traded trusts. That's the solution in the regulatory environment in the US. And Osprey sponsors 5 of these trusts. OBTC is our Bitcoin trust. It is the least expensive version of tradable Bitcoin on the US market. But the thing I thought I'd focus on just real quick to leave you with something that might help you in terms of trading your account is how these things work, because they're not like a regular ETF. They trade at premiums and discounts. They're sort of like a closed-end fund. And a lot of times this catches people off guard. Right now is actually a decent time to get into these products because they're trading at a discount generally. So you can get access to crypto at less than sort of fair value. But it all depends on when that gap closes and what it closes to. I remember before we had a product, I had to buy my competitor's product, who shall remain nameless, but I bought their fund at a 10% premium. Bitcoin went up a lot, and the fund expanded to 100% premium. So these kinds of trades can really, provide a tailwind to your strategy. They're not going to be as liquid as the products, as the stocks that you're probably fond of trading. But I think that this is coming. Crypto's not going away, right? At the end of the day, crypto is more than just a digital alternative to gold. It is emerging tech. The way people are organizing themselves, capital and labor, is changing, and they want to do it in a decentralized way. It's my kids' generation, but that's not going away. So I suggest, if you're not involved with crypto, start to learn more about it. These things trade like crazy. There's going to be more risk if you're trading crypto directly. That's why we like to provide a solution that's tradable in your brokerage account with a ticker symbol. The assets are segregated and held with a custodian. It's all sort of professionally managed, and it takes away a little bit of that personal risk of losing your private keys or whatever to your crypto account. So check us out, ospreyfunds.io. Okay, not .com. I'm sure you can figure that out. And if there's any questions, I'd love to answer some. We just have the Bitcoin fund, and very soon we'll have a Polkadot fund and a Solana fund. Yes, from the hater. That's all right. I know it's tongue in cheek. So we don't have an Ethereum fund. There's another Ethereum fund on the market, but we just at the timing. So we launched our first fund in early Q1 of 2021, so only about a year ago. Ethereum, just the dynamics in the market with their transition from proof of work to proof of stake meant that we'd have to lock it up to stake it, and we just wanted to wait until that transition happens, and you could see an Ethereum fund from us later. All right, thanks everybody.
All right, let's bring on our next speaker here, Scott Acheychek from RecShares. Scott?
Great, thank you very much. Shows Pandora users don't like it when ads interrupt their music. So to help you remember that Liberty... All right, well, thank you, everybody. Thank you to the team from Benzinga and Jonah. So far, it's our first time being here. It's our first time sponsoring this event, and we love it. So I'm quite sure you guys will see RecShares again down here. So real quick, I guess, we'll do a little poll here. How many of you guys trade leveraged or inverse equity ETFs or ETNs of any kind? Okay. Oh, nice. The crypto hater trades. He doesn't like the volatility of crypto, but he trades levered equities. That's nice. All right. So RecShares is the firm that many of you guys probably have never heard of, but it created the brand Microsectors. So our whole goal there was to create trading products that more or less we would want to trade. Our entire goal and the very first products that we launched were levered FANG products. So it was like a 10 stock basket, think like the biggest 10 tech names in the United States, smack some leverage on it and just kind of really isolate that big tech trade. One of the things that really gets to us and the way Qs is kind of presented to the world is like some kind of big tech barometer. It's kind of bullshit, right? Despite the little lady in her polygon suit and the commercials and all that other nonsense, the reality is it holds things like Costco and Pepsi and like Marriott hotels and just a lot of stuff. So we wanted to try to isolate like that targeted exposure to big tech. And it worked. Our first two products did pretty well, and then that kind of launched the rest of this brand. So we've also went in other areas like financials. If you think about the world of financials, a lot of times it's just like a lot of shit in your portfolio. It's credit card companies, it's lending companies, it's savings and loans, it's regionals, it's credit cards, it's stock exchanges, it's everything. So what we did, we created a basket that's just the 10 biggest stocks in the United States that are banks. So everything from like your Morgan Stanley, Wells Fargo, like the names that you guys kind of know and follow are the products that we're kind of creating. So that's our whole goal. We have some new and exciting projects that we're working on. So if you guys do touch on the leverage space, please come by our booth or go to our website, microsectors.com. I'll pause there. Is there any questions on anything as it relates to levered products that are not buy and hold forever? Yeah. We're pretty much market agnostic. I mean, obviously, I would say the majority of our assets are kind of like in the upside kind of plays. But yeah, we have short side products as well. And as you can imagine, short FANG has been absolutely killing it lately outside of Friday. Yeah, good. Direxion, yeah. So basically, the SEC more or less created a duopoly a few years back as it relates to levered and inverse products. So they for the longest time, it was just ProShares and Direxion were the only ones that were able to issue 3 times levered products. So we found another way to issue those products by partnering with Bank of Montreal on a series of ETNs. So I think, like I was saying about those baskets, whether it's like, levered Qs as a tech play or, FAS or one of those kind of like levered financials, our products are just constructed quite a bit differently. Again, we are traders at heart, trying to build really cool products that kind of solve real solutions. Again, not necessarily for the buy and hold crowd, but for the active trading crowd. You have another question? Yeah. Our expense ratio is 95 basis points. I think the average product is probably around 100 basis points for that, for the levered and inverse space. And, the reality is, you're not paying the full 95 basis points because you really shouldn't be in this thing for an entire year. But if you're toggling between the long and short every day, then yeah, you would probably wear that 95 basis points. We have 2 suites of energy products. Yeah. So we have Big Oil, which is an index we created that's, kind of similar to like the bank product I mentioned. It's just the biggest 10 energy stocks in the United States, and then smacked with 3 times and minus 3 times leverage. And then we created a second basket that's a little more diverse, a little more focused on the E&P space, which has been doing pretty well as well. As you can imagine, it's been an interesting time in the energy space. Mr. Crypto Hater. Yep. Sure. Yeah. Yeah, I mean, we have a few institutions that will literally trade these things in and out several times in a day. And then we have some that are just looking to put on maybe like a 2-week swing trade if they believe the trend is in their favor. Like, this isn't something you want to just like, oh, yeah, I don't know, I'm going to take a punt. It's something I have conviction in, whatever it is, long or short, whether it's energy stocks or gold miners or whatever it is. And then you look to, try to play your trend. But, you have to be obviously careful, stop loss, all that kind of fun stuff. Any other questions? All right, well, thanks, guys. And we have some killer swag here today. We have the super soft t-shirts that are absolutely awesome. So please come by, grab some. Thank you, everybody.
All right. Great job. That's all right. Thanks, Terry. Appreciate it. All right. Let's keep it moving here. We're going to bring up our next speakers. We got 2 of them. Let's bring up Dillon and Justin from Wolves of Wealth. Guys? There we go. Awesome.
Well, good afternoon, everybody. I think it is afternoon now, almost. My name is Justin Banks. I'm the founder of Wolves of Wealth. Little background around. Hello. All right. Welcome, everybody. My name is Justin Banks. I am the founder of Wolves of Wealth. A little background of why I founded this community. I'm originally from here, actually Las Vegas, Nevada. And I actually worked in this hotel. So I worked at the Aria in my early 20s. I worked in the nightclubs downstairs. And I would go to work every day. And I would see everyone around me, just getting old. This one guy in particular kind of looked like Snoopy, a little bit. He had a droopy face. And, he looked like he was past retirement. And I just remember going there every single day. And, I didn't want to be that guy that just grew up in Vegas, stayed at the casino, grew old in the casino, and then, had to work past my retirement. So in the year of 2020 during COVID, I founded the Wolves of Wealth community because I wanted to help people become financially free so they didn't have to grow old and work until their retirement. So that brings me to our next speaker. We have Dillon. He is a member of the Wolves of Wealth, and he is a teacher, but he's actually going to be retiring this year thanks to our community. So I'm going to have him speak a little bit about our community and give you the floor. Here's Dillon.
All right. Thank you, Justin.
Thank you.
So, yeah, my name is Dillon, and I've been a teacher for the last 11 years, and I'm very happy to be doing that. However, one of the most valuable things, as we all know, that exists is the thing we can never get more of, which is time. And so trading has really helped me find a way to use my time in a way that is more valuable to myself and my family. And Wolves of Wealth really helped me get there, because what Wolves of Wealth is not just a call out channel. It is a bunch of like-minded, very competent traders like you guys are. Like, this conference is fantastic. A lot of people here are very, very good at what you do, and it's really cool to see. And we're trying to build a community where we all help each other in getting better at different parts of trading. I only trade the first 30 minutes of the day because I have a job to get to, and that's something I'm specializing in. We have someone in our group that works real hard and does a great job with swing trades. And so if I need help with that, there's someone to help me know how to get into a different style of trading. So there's a lot of people that are very diversified in their skill set that they bring. And that's one of the cool things about the Wolves of Wealth. So we're working on building a community that is all encompassing for financial health, financial freedom, and mental health and physical health as well. So that's basically what our community really is. And Wolves really helped me hone in a lot of skills that I didn't know I was lacking in, because when you're able to talk to other traders, you figure out what they are doing and apply that to yourself too. So there's no super secret formula in call out channels or anything like that. It's just helping each other get better as we grow through this trading life. So that's what we kind of do. Again, I have my own channel in there, and I'm working on helping teach people that have little time, like myself, get more time later on, and that's kind of what my specialty is. And so we all have a lot of cool things to offer for that. So,
Yes, this is pretty much. Don't stay because you're just leaning on call outs, and that is what the Wolves of Wealth community is. And I hope to retire more people with it. We have 5,000 members strong, and we're only growing bigger every single day. So I'm excited that I was able to speak in front of you guys today, and I hope everyone has a good rest of your day. So thank you.
thank you.
Both mics. All right. Rounding us out here, last speakers before the all-important lunch. Let's bring up the Seeking Alpha team. Justin Giles and Jay Mintzmyer, they were here yesterday. If you missed them speak, catch the recording. It was a very good panel. Justin and Jay, here we go. Seeking Alpha.
All right, thanks everyone. Thanks for having us. Great to be here at this event the last 2 days. It's been fantastic to listen to all the speakers and then to really network, and really grateful for the opportunity for everyone who helped put this together. Just real quick, again, yeah, we're with Seeking Alpha. Just some stats. As you can see, we have over 17,000 contributors. Seeking Alpha has been around since 2004, and it started out, David Jackson, he's our CEO and founder. He started on Wall Street in the 1990s, and you really saw with the rise of the internet, with blogs and everything, how that kind of would take off. And so his purpose was, he worked on Wall Street, but he didn't like that, Wall Street had all the information, like talking with the retail and investors, he saw they had so many great ideas. And so he founded Seeking Alpha, and it's just taken off since. Since 2004, we have 17,000 contributors. That's just how many contributors have been all throughout our time. We have about 1,000 or 2 that are active. Just last year, we covered 8,000 different tickers. So if there's a company that you're interested in, if you type in the ticker, there's going to be some articles written about it. So that's really cool. We have 7,000 articles and earnings transcripts per month, 200 million page views, and 17 million monthly visitors. And so I won't bore you with more of those stats. I brought Jay Mintzmyer. He's one of our marketplace authors. He's been contributing on Seeking Alpha for over a decade. He's one of our top authors. And so he's kind of going to share his story about how he started writing on Seeking Alpha and kind of where it's taken him from there.
Yeah, thanks, Justin. Seeking Alpha has quite literally changed my life, both as an investor and also as someone who offers a research product. I started writing on Seeking Alpha in 2011. I was just finishing up college at the time. After about 4 or 5 years of doing deep value and things like that, I realized the shipping sector was where I could really excel and outperform. How many people have heard about Zim? Yeah, Zim, right? That was one of our stocks from pre-IPO. We were analyzing the filings. We got in that. Seeking Alpha is great because they offer you the potential to write blogs, write articles, open source, but you can also develop a community and craft your own service under the Seeking Alpha umbrella. And they'll market you, and they'll help you grow your business, and they'll give you those features like chat rooms and things like that that will help your business grow. So thank you to Seeking Alpha, and excited to see everybody here. Thank you for coming to the conference, and we look forward to being part of this in the future.
Awesome. Thanks, you guys.
All right, and that means it's time for lunch. So I will see you all next door, and I'll see you back here in an hour for the rest of our show.
We're live. All right, everybody, welcome back from lunch. I hope you enjoyed some delicious food. I am very excited for this one, not just because I'm on stage, but because we have the honor of hearing from Mark Minervini, one of the greatest traders of our generation, as well as Richard Moglen, also known as the second greatest trader of our generation. So, without further ado, once Mark's on screen, we're going to get right into it. I'll leave my cues to the guys in the back.
All right. Hello, everybody. Can you hear me okay in the back? Yeah, sounds good. Welcome, everybody, once again. Today we have the honor of interviewing.
I cannot hear anything.
Hey, Mark, can you hear us? No.
We can see you, Mark.
Hold on a second.
No, I definitely can't hear us yet.
Okay. I can now hear you.
Perfect.
Hey, Mark, how's it going? Can you hear us okay?
I can hear you now.
Perfect. Well, let's go ahead and get started. Welcome, everybody, once again to an interview with Mark Minervini. My name is Richard Moglen, and today we have the honor of interviewing Mark, who is a two-time U.S. investing champion. He's also the author of multiple excellent trading books and mindset books, including Think and Trade Like a Champion and Trade Like a Stock Market Wizard. And I'll leave it to Gab to start with some opening questions.
Absolutely. So let's get right into it with a little bit of background. Now, many of you may have heard of Mark, but I think it's important to understand, Mark didn't just wake up, and get born and he was a trading champion, right? There was some background to this. Something made this happen. So Mark, I'd love to hear from you a little bit on how did you even get started in the stock market? When's the first time you heard about it? And what made you say, this is something I want to do?
Well, first of all, let me just say I'm happy to be here, and I'm sorry that I couldn't attend in person and meet everyone and shake hands, and it would have been a lot of fun, but at least I'm here virtually. So hope that you guys are having a great event. I'm sure it's beautiful out in Vegas. When I first started in 1983, so a long time ago, probably a lot of you guys, certainly you, Richard, and some of you young guys that, of course, I know you guys from University of Maryland and for quite a while now. You guys probably, either weren't alive or certainly were little babies in diapers. So it's been about 39 years now since I've been trading the stock market. I started off doing the exact opposite of what I do today. I started off buying stocks, 52-week lows, low price stocks, low PEs, value buying, doing just about everything in the complete opposite of what I do now. And I had miserable results for about 5 or 6 years. I didn't even make money. Then I flipped everything around and started making money in the late 80s, around 89. By the time 1990 came and the 90 to 91 bull market, I was pretty prepared to take advantage of it. And that was where things started really turning around for me. But funny thing, I don't know, when I was like 8 years old, I used to love looking at the stock tables. I didn't even know what they were. And I used to look at the stock tables, and I used to play these little games while I would circle things in the stock tables. So I don't know, maybe I was destined to be a stock trader.
I love it. So 1980s. So you're starting out, and what's the first strategy? So you're saying you're buying those 52-week lows, and so you're using a bit of technical analysis being implemented into it. When you're first starting out, were you looking to others to garner these strategies? Were there people who were perhaps, giants in the trading world at the time that you were attempting to copy or learn from?
You're showing how young you are. I didn't know anybody. There was nobody to know. There was no YouTube. There was no internet. There was no nothing. So to be honest with you, I can't even remember, who even would have inspired me, in the very early period to get involved with stocks. But you said technical analysis. I didn't have technical analysis. I didn't even know what technical analysis was. I bought a company called Alice-Chalmer. It was a company that made forklifts and tractors at 4 1/8. And it went up to $8 like within a couple months. And I said, wow, this is easy. And just thought that was the way. You just buy low price stocks. And then I got some advice from a broker, and he had me buy this company that had a drug for AIDS. It was supposed to have an AIDS vaccine. It was called Imereg, was the name of the Imereg Class A shares. And he blew me up. He had me buy it all the way down. He kept saying it's a once in a lifetime opportunity. The stock went down 50%. He said, buy more, went down more. And I just kept buying it. And I ended up blowing up my whole account. and then I had to rebuild all over. Then I tried to get it back real fast, so I went into options. I blew myself up there, and then that was sort of the best thing that could have happened to me.
Sounds like a lot of early struggles, something I'm sure many of us can relate to. What was some of the ways that you took these early struggles and learned from them? Where was the turning point?
Well, I mean, the turning point, well, first of all, William O'Neill came out with Investors Business Daily, and I went to an O'Neill seminar. David Ryan, many of you know, has worked with me for many years, presenting the Master Trader Program. He's a very good friend of mine. At the time, of course, I didn't know David Ryan, and I didn't know William O'Neill, but I went to the seminar. I read O'Neill's book. So I started off really, moving in the right direction from O'Neill. I also read Richard Love's Stupid Performance Stock book. And what happened was when I read O'Neill's, I realized, I said, wow, this sounds very familiar. And later on, many years later, when I did a lot of research, I realized that O'Neill was influenced by Love back in the 60s. And he took basically Giller's work and Love's work and put it together and came up with CanSlim. Many have heard, of course, of the cup with handle pattern that started off as a saucer and platform from William Giller's book, and O'Neill just retermed it. And then all the factor modeling that he did was really just a modern day version and with better computer power of what Richard Love did.
Love it. All right, just a couple more introductory questions here, and then I'm going to turn over to Richard to really dig into the trading style. So one other question I have is, and the reason we're all together here is because of this idea of FinTwit, right? Finance Twitter. What caused you to hop onto social media and start sharing some of your insights, over the last year, even 2 years, while we had this run up? You were consistently posting insights saying, this is going to hurt retail traders. There's going to be this downfall, right? Just trying to be there for people. And you've amassed a large following, right? 400,000 followers verified on social media. What made you want to grow on this type of platform and engage with people there?
Well, everything that I do today, from the books to the seminars to even the service that I have, really came by accident. I didn't mean to even get into this business, not by a long shot. I was actually retired, as a trader, and McGraw-Hill was after me to write a book for like 10 or 12 years, and finally, I decided to write the book with McGraw-Hill, my first book. And from there, I just got people contacting me saying, do you have a newsletter? Do you do a seminar? All these various things. Twitter, I hopped on because, someone just told me about Twitter. I actually got offered to invest in Twitter before Twitter was even public, or even not, and I don't mean public as a stock, I mean public, like before they were even an operating platform. And I thought it was a terrible idea. So I said Twitter, it sounded so, the name sounded so quirky. And I said, I don't want anything to do with it. And of course, it ended up being where I've been on Twitter since 2010 now. So yeah, and over the years, even with the little workshop that I did, the workshop was a testing ground. When I was working up information for my book, I used it as sort of just to test the information to see what resonated with people. And then, because when you're live and you're with people, you get to see exactly, and you meet them. You see exactly what resonates with them and what strikes a chord with them. So it was all sort of just homogenous how it worked together, and then it just turned into a business. And now, of course, years later, I have a lot of books, and it's turned into a pretty nice business. Where and again, every year, whenever I do the seminar, probably for the last 7 years, my wife and I would always say, "No, this is the last one. I'm not going to do this again." Then all these people would come up and hug me and tell me how great the information has helped them and changed their lives, and say, okay, one more year, and now it's 12 years.
I love it. So final question here, following up on the Twitter concept. There's a lot of different thoughts about how people engaging and communicating via Twitter can assist or hurt their trading, right? We fall into often a bit of a groupthink mentality where people are now just following others into trades, and that doesn't often work because they don't get told when to sell, right? It's just the buy signal. But then on the other side of it, there's so many people who have learned new styles and learned from people like yourself. Do you find any value personally? Do you learn anything from that FinTwit community, and do you think that there's value for others to be a part of it?
Well, we can learn from people that are doing things wrong. We can learn. I learned a lot from, early on in my life, if you read my mindset book, I had a lot of bad example in my life, and I learned a lot from that, what not to do. So we can learn from anyone. I learn from everyone. So teaching is a great way to learn. But when I first started trading, I was going to the library and I was reading books that were outdated and on strategies that never worked in the first place. So there was no information. It was very hard to get information. Now you have the opposite. You have information overload. You have everybody's a self-proclaimed expert and you don't know who to listen to. So, both have their pluses and minuses. I'd rather have the information overload and have the information available, and then you have to sift through it and figure out who to listen to based on, track record and reputation, I guess.
Love it. All right, we're going to start digging in now to the real nitty gritty with the trading, the strategy, the style. I've been talking a lot, so I'm going to turn it over to Richard to get us started there.
Perfect. Thanks, Gav. And Mark, just to kind of give people a frame of reference, if you could just kind of describe a little bit about your overall trading style, how you would describe yourself as a trader, I think that would help everybody who maybe isn't as familiar with your work.
Well, okay. Well, I mean, I wrote books on this, so you can read, my books and see everything that I do. I mean, my style is what I would call a conservative, aggressive opportunist. And mainly what it means is that I pursue very, very aggressively the long side or whatever side I'm trading from a very low risk standpoint. So I'm trying to find, relatively speaking, large reward versus my risk. I'm extremely risk adverse, but I'm also extremely aggressive. So I call it a conservative aggressive style. It combines technical analysis, fundamental analysis, all culminated together. And then I try to time trades at a point at which, not as much of trying to be right all the time, but just I want to know if I'm right or wrong very quickly. So even if I'm wrong, I want to know quickly so I can move on and then move on to another trade, because compounding is what's real important to me, is turning over the money and compounding it very rapidly. And that's how I get those big returns.
Perfect. I think that provides some good context. And I do want to focus a little bit on sell rules, risk management, because I think that's very applicable in the current environment that we're experiencing. So to just kick things off, Mark, I'd love to hear just kind of some overall risk management principles that have helped you kind of stay in the game for decades and participate in all those bull markets, because you've been able to preserve the majority of your capital and keep those drawdowns as small as possible, so you've got that capital to work with during the next bull run.
All right, Richard, you're going to have to lip read.
Yeah, Mark, right now we can't hear you live in the audience, just letting you know.
All right, I'll defer to the guys in the back. We got audio coming? All right, Richard, you got your risk management principles backup speech ready?
Yeah. I'll ad lib. I can't top Mark, but yeah, I would definitely want to cover the 50-80 rule, because I think that's definitely super interesting. While we're waiting, any questions from the back? Should we take some questions that you'd like to ask Mark?
Interesting. All right. Well, I'll actually ask Richard in the meantime. For anyone who doesn't know, I love to interview Richard. Richard comes on every single Thursday. We actually do a live power hour with Brian Shannon. A lot of you probably saw him the other day. And we talk stocks, risk management, technical analysis. And Richard's a fantastic investor. So while we're waiting for Mark to get back on, I'd actually love to give you the opportunity to talk for a second or two about how you've been managing your risk in this market, because it's been a little crazy for 4 months.
Yeah, so my style is actually pretty similar to Mark's. I've learned a lot from him, his books, his seminars, and the overall Kansas background. So in terms of how I view the markets, I look at the indexes, their trends, as well as the current state of market leadership. And I want to be as invested as possible when everything is in strong uptrends, trending nicely above those key moving averages, the 21 EMA, the 50 SMA. And when things start breaking down after a significant run like we've had, where the leaders start losing those key moving averages, we're seeing failed breakouts in Roku, all the stocks that that were the leaders in 2020 and 2021. Once those leaders really start falling, that's something that you should pick up on, because it means the environment is changing a little bit. And once that happens, kind of naturally, if you're using stops or using moving averages as spots to exit the trade on weakness, basically you're kind of pushed naturally to cash, and you want to take a little bit more of a conservative approach, put on smaller positions, progressively exposed to the downside as well as the upside. And I do see that Mark just popped back on, so we'll see. Mark, can you hear me now?
I think he can hear you.
Yeah, we're still not hearing Mark up here. So yeah, in terms of the current environment, when we're in a downtrend like this, if you're a position trader, swing trader, less is more. And we really want to be watching for the development of new setups, new leadership groups, and for those trends to appear once again. So once stocks start building above those moving averages, get back above all the longer term trends using the 200 SMA, 50 SMA, that's when you can kind of step on the gas once again and put on those pilot trades. And if those start working, add new positions or increase your overall position size. So that's kind of how I'm viewing the current market.
Love it. All right. So I know we're still working to get Mark back on here, and everybody stick around because the knowledge that we're going to hear from Mark is incredible. He's one of very few investors who has had, one down quarter over the last 10 years?
Impressive performance.
Yeah, one quarter down over the last 10 years. So we're going to make sure we get him back on here. I'm calling conspiracy too. Somebody wanted there to be technical difficulties today just for the memes. But I'll keep it rolling here. So I actually have another question that I wanted to throw over to Richard. And this one's about discipline. It seems crazy.
Can you hear me?
There we go. Look at that. All right.
You can hear me?
Yes, we can hear you. Can you hear us?
Yeah, can you hear me?
Yes.
I can hear you the whole time.
Perfect. So great to have you back, Mark. And to kick things back off, I'll re-ask my question on risk management because I think this is super relevant today. So what kind of rules regarding risk management, respecting stop losses, keeping track of, changing environments have you kind of developed over, your career as a trader that have kept you in the game and kept you out of the worst of the bear markets?
Okay, so first of all, I think we should mention that this particular environment that we're in right now is a great time where I think people are open-minded to talk about risk. Some people who maybe might not have, maybe they were too new to the game or got rewarded for having a strategy or an approach that didn't have much of a risk mitigation part of the plan. Let's just put it that way, professional and amateur. So now that you talked about the 50-80 rule, we certainly can talk about that. Now that we've seen stocks go down, many stocks, 50, 60, 70, as much as 80 and 90%, there's a lot of people that didn't realize that this could happen, and it can happen in such a quick fashion, and it can happen even in some of the big names that they never thought could fall. So I mean, in all the time that I've been doing this, and if you ask William O'Neill the same question, or ask any of the traders that I've known, that I've respected and have long-term great track records, none of us have figured out a better way to manage risk or to avoid a big decline other than taking a small loss. There really isn't another way without putting on more risk. I mean, people say, well, you can hedge and write options or buy puts and so forth, but that's just adding risk. You can lose on both. So again, that's the most basic. Now it sounds easier than it is, because there's also a downside to that. There's always two sides of the coin. When you use a stop, you could get stopped out many times if you're not using that properly and timing your trades properly, and you're buying extended stocks, or you're fighting the market when it's in a downtrend. You just keep trading and trading and trading. You could get death by 1,000 cuts and blow yourself up with stops. So it's not a free ride, but it is the starting point. And you asked before what was the thing that turned me around, and I talked about this in my book and many times before, where I started hearing, of course, about cutting losses from O'Neill and some of these guys. And I said, okay, I was cutting my losses, but every now and then I wouldn't. And I would get a big loser because I'd fall in love with the story, or the stock would go down so fast that I would say, okay, well, I'll wait for it to come back. And then it'd go down even more. And I'd say, okay, well, now I'm down too much. I can't sell now. And now it's down 30% and then 40. And before you know it, I'm throwing in the towel, down 60%, completely blown up and demoralized. Everybody can relate to that. We've all done that. So what I did was I went back and I said, arbitrarily, let me just see if I went back and I don't remember how many trades, maybe 150 trades or so. I said, let me just see if I had cut these losses arbitrarily at just 10%. And even the ones that I cut shorter, like 5% or 7%, I made those larger to 10%, but I made all the big ones smaller to 10%. What would my performance be? At the time, I was down about 15% on my account. I ran the numbers, and it came out to where I would have been up almost 80%. So I said, there must be something wrong. Obviously, I did something wrong with the calculation. That can't be. So I ran it again. And sure enough, it was the same numbers. I ran it a third time. It was the same numbers. So I learned very quickly that, wow, the downside, protecting the downside could really shift the whole equation. And then I started looking into how futures traders were trading. I met one gentleman who was a very successful futures trader, and started using probabilities and analyzing probabilities and using bell curves and things like that. And I really dug into the math, and that's where everything changed. When I started, my focus became on the risk-reward relationship as opposed to just trying to find a big winner.
Absolutely. And another key topic that you discuss in your books is progressive exposure, which I think is something that's extremely beneficial to learn about. So could you describe a little bit about what that is and how you take feedback from recent trades and basically use that as a guide to either scale up or scale down, so you're trading your largest when you're trading your best, and you're not really exposed when you're trading at your worst.
So the goal of any trading strategy should be, of course, you want to make a profit. We ask most people, what's the goal of your strategy? To make money, right? Okay, well, maybe we take it even further and say, well, the goal is to make more on my winners than I lose on my losers. Okay, that's the holy grail. But the real goal that you really have to be careful, you have to try to focus your strategy in this direction, or in these two directions are, you want to make sure that your strategy forces you to be trading your largest when you're trading your best and your smallest when you're trading your worst. And that you want that to be sort of automatic. You don't want to have to say, oh, well, I like the market here, and now I'm going to trade larger. You want to have some type of mechanism that forces you to trade larger when things are going well and forces you to trade smaller when things are not going well. And that the reason why is because the average person, what they normally do is they'll when the market takes off and it looks extended and it looks like it's overbought, and they get some profit, they sell into it, and then there's a lockout rally happens, and they sit there and they just watch it, and they don't make any money in the bull markets. And then when the market rolls over, they think it's oversold, and they start trying to double down and get even. And before you know it, they're trading large into a downtrend, and they're trading small into an uptrend, or out during the uptrend and in during the downtrend. So you want to be, when the bull markets are happening, you want to be heavy. Stanley Druckenmiller said, you got to be a pig. Every now and then you got to be a pig in the market to make big money. You also have to know when to be a chicken. So to me, it's sort of, knowing that shifting between pig and chicken is really, I think, one of the keys to the difference between a real professional trader and everybody else. This is something like Mark Ritchie, who, is side by side with me daily, and we discuss this stuff all the time. He's really good at that. Him and I both are really good at stepping on the gas. When things are going really well, we'll slam it to the floor and just get incredibly aggressive and make tons of money in just a short period of time. And then we have the luxury of sitting out for extended periods of time and not fighting when there's all this noise and the market's difficult. And then we're in cash. And I'm always in cash when the market's in a downtrend. I've never been caught in a downtrend ever. Not even when I didn't even know what I was doing in the beginning. In the 87 crash, I was even out. I would at least bend with the market somewhat. So that's the key.
Perfect. And I kind of want to dive a little bit deeper into that and maybe use an example, given we're in a correction now and a lot of people are completely in cash. Say we do see setups start to emerge. We see those leadership groups starting to show relative strength. How would you go about putting on some test trades, and then if those start working, increasing that size, and how fast would you do it, and what kind of position size would you get to?
Okay, so I forgot. I'm sorry. I didn't really address your question. Your question was about progressive exposure, or at least your comment was. So, progressive exposure is really, it's a concept that I think is misunderstood by most people, but you should really that's the concept you should really dig deep into, my explanations, and then work with it, because it goes hand in hand with your risk management with stop losses. And a perfect example is if the market were to start, or I say the market, but let's just say stocks were starting to set up, and there was some stocks that met my criteria, I wouldn't just plunge in and just start buying like crazy. I would buy some small positions and see if they work from a very low risk standpoint. So I would have smaller positions from a very low risk. So overall, my risk would be very, very small. So I can do that a bunch of times and not get myself in trouble. So now if I get some traction, I've now gotten some profits, and I would use those profits to then finance a bigger position. That's now financing my risk. And seeing as you're in Vegas, I might as well use a poker analogy, because I always use poker analogies. I used to play a lot of poker in my day. And when I used to go to the casino, and I'd play on the regular game that I normally played was a 10 and a quarter game, no limit. But a lot of times you couldn't get on the table. There would be a wait list. So I'd go play on a smaller game, like a 1-5, a 1-2, or a 2-5, or even a 5-10. So the goal was now two things can happen. Sometimes, you go on the 1-2 and you're normally playing this big game. So you're like, oh, this is just a little game. You start throwing chips. And before you know it, you're at a pretty good loss because you didn't take it seriously. That's number one. But the key that I would try to do is I would try to build up a little bit of a bankroll on that smaller game and work myself up, and maybe work to the 2-5 or the 5-10 table and build up a little there. And then when I get to a larger game, around tournament time, there would be 20, 25 quarter and a quarter games, 50, 100 games even. These are big games. I want to go into those games with some profits and have some cushion, so I don't have this pressure on me. So I would build myself up. So I think progressive exposure might have happened with my stock trading. It might have actually been a natural progression from my poker playing, because that's how I played poker. I would always, even if I start playing, in a game where I know people say, well, aces are, you should just shove in with aces all the time, or, with certain probabilities. And they just play aggressive right off the hop because the odds are the odds. But you have to remember, those odds are over 100,000 hands or 1 million hands. I mean, I've lost with aces four times in a row and shoved in all my chips in a big game and ended up with a gigantic loss. So relating that to the market can stay bad longer than you can stay solvent. So you can't think of it in probabilities that way. You have to there's a risk of ruin. And depending on the size that you're trading, that risk of ruin, of course, is larger or smaller. So progressive exposure is simply just building small success leading to larger success, and building into your larger positions, and building down too when things aren't working.
Perfect. Yeah, I think that's an excellent explanation. And given that we are in a correction, I want to dive a little bit deeper in terms of what you're doing on a day-to-day basis to stay on top of ideas that are maybe shaping up. So, Mark, do you have any kind of go-to scans during periods like this where you're looking for that relative strength, you're looking for leaders that may be developing? What are you kind of doing on a day-to-day basis to try to find ideas if the conditions start to improve?
There's no magic scans. I mean, I'm using the same scans that I've been using for 30 years. There's no magic scans. That's the least, if anything, you want to learn, from what I do, the last thing would be the scans. I mean, I can give you a few utility scans that I would use during certain periods, markets that are in corrections, but generally I'm looking at the higher relative strength names. And once I find, names that are in an uptrend, of course, in MarketSmith are my trend templates. You're going to want the stocks to be in an uptrend. You're going to want the stocks to be in bases, have good relative strength. And then from there, then I look into the fundamentals, see what the company does, and categorize the company and figure out if this is a turnaround situation. Is this a cyclical? Is it a institutional favorite, maybe a stalwart, or is it a true market leader? And then that's how I approach it. That lets me know how I need to approach it. If it's a drug stock, I'm going to not be looking at earnings because 80% of them don't trade on earnings. So I'll be trading strictly off the chart. So categorizing the company and going through that is more important than, the actual screen. Now, as far as when you're in a correction like you are right now, sometimes what I'll do, let's just say you're in a 10-week decline, I'll run a 10-week relative strength and then just see what's held up throughout that decline. You could also run a relative strength new high screen. Like, that's a good screen to run when you're in a correction, because now you can find stocks that, to get a relative strength moving up, it doesn't have to be where a stock goes up. It could be that it's just going down less than the market, or even just going sideways, the market's going down. So at that particular time, in a correction, I'd be looking for, relative strength, new highs. So that's what I call utility screens, where in certain instances, I will run a few of these different screens that I'll apply for that particular moment in time. But that's about it. Otherwise, there's no real magic. I run an IPO screen. I'm always aware of all the IPOs that came public in the last year, and watching those. But the screening is actually quite basic. It's the rolling up the sleeves and doing the real work. That's where the work is, and where the magic comes from.
Yeah, perfect. And Mark, one thing I've always been impressed with is kind of your discipline and how prepared you are. So I want to ask you kind of how you set up your daily routine. So every day when that trading bell rings, when 9:30 Eastern time hits, you're ready and you're ready to go and to act on any ideas that you have in the market.
Well, most of my work's been done the night before, so I'm not really doing a whole lot pre-market, except seeing if the market's going to be up or down big, checking, if earnings reports came out and so forth, standard things of what would affect my portfolio. I prepare in the morning. I do 10 minutes of deep breathing and mental visualization prep before I even get out of bed. I turn the TV on first and just see if the market's down 1,000 points, then I know I got to start doing visualization about cutting losses and handling stocks that are going to have me under pressure. And then, I just go and I look at my list, my watch list, my buy alert list, what's on deck for potential buys, and see if they're going to gap. And that's about it. I mean, I do the same thing over and over. I've been doing the same thing. People always ask if anything's changed with all the technology. When I first started doing this, I was charting on graph paper. I was physically hand charting stocks. I was hand plotting moving averages. I was hand plotting oversold, overbought oscillators. I was doing everything by hand. I was going to the library and going on microfiche and Barron's and Wall Street Journal to get data and then back test things. I mean, you want to talk about really, really arduous, roll up your sleeves work. My sister and her friends, I would pay them a couple dollars an hour to calculate moving averages and things for me by hand on paper. I had all these stacks of these books and everything that I had of calculating all these statistics. So it was really, you would think that now you would have this technology that would do all that work for you. Yes, it does calculate the charts and all that, but there's nothing. I'm doing the exact same thing. It's on a chart. There's no real advancement of any kind of real magical thing that's the technology is going to do the work for you.
Perfect. And I'm going to ask one more question, coming back to the 50-80 rule, and then I think Gav is going to move on and talk about the championship last year. But Mark, we've touched a little bit, and I think you mentioned the 50-80 rule, but some people watching might not be familiar with that. So speaking of going and doing studies, can you kind of talk about the work that went into looking and finding these statistics, and also kind of how you apply it day to day in your trading?
So everything that I do is not just based off of some idea off the top of my head. It's based on real scientific testing that goes back, and not back testing. Okay, there's a real important distinction between back testing and then what I do, or someone like William O'Neill has done, which we call factor modeling. Big difference. The difference is testing. You basically check everything and find out what works, what gets you to a result. So you go back and, if you took and went and analyzed the pattern of beetles scurrying around, you could probably find some pattern. Now that's how you get the NFL indicator, and you get all these crazy indicators, which is all bullshit, because it's just curve fitting. You're just curve fitting and finding whatever gives you the answer that you want. Factor modeling is the exact opposite. Think of it as you're going to go and get a baseball player for your team. You're going to go back and you're going to go find out, get someone who's got a great batting average. You're going to go and you're going to see what are the characteristics of a great player. And then you're going to go and pick your players based on that. So factor modeling is you go back and you find out what had performed and then look at the characteristics. Or think of it as, looking at an Olympic athlete and say, okay, well, let me go look. Is there something that these people eat? Do they all eat the same thing? Do they all do a certain type of exercise regimen? Do they think certain thoughts? And going back and finding what are the similarities and the commonalities among those great athletes. That's what we do with stocks. So, that's, I don't remember your question, but that's the starting point. That's the starting point of factor modeling. Everything that I do is all based on that. And I guess it was the 50-80 rule you were talking about. 50-80 rule states that, and this is just going back and looking at history of secular leaders. When a leader tops, when I say a leader, like a stock like a Netflix or a stock that has led the cycle, sometimes a stock that's led late in the cycle, like a Zoom or something like that. When these stocks top, after they make these big moves, there's a 50% chance that they'll go down 80%, and there's an 80% chance that they'll go down 50%, generally speaking. And the average decline of those secular leaders once they top is about 70%. And generally speaking, they don't come back and recoup that for at least 5 years, and in some case, 10 to 20 years. So that's a very, very ominous set of figures. So you don't want to be around a leader after it tops. It tells you that the probabilities are really, really stacked against you. And that's where, we get into this. And I know a lot of people think, I'm against
Dun, dun, dun.
If that strategy works for you, God bless you. I know what works for me, and I'm an expert in one particular area. And that's one thing I would suggest, is that you make sure you master an area. If you're going to do the bottom fishing thing, we'll be the best bottom fisher in the world. But the thing that I am against, and that is having any of those strategies without a plan for the risk side of the equation, because you're going to be wrong. I don't care how good your fundamental analysis is. I don't care how smart you are. You will eventually be wrong. You will eventually be very wrong. And at some point, you will be wrong for a long time. So you have to have some mechanism that protects you, because big returns mean nothing if you have big drawdowns. It'll all be given back, and you'll underperform, and you won't be consistent. And consistency is the key to longevity.
Awesome. And yeah, I think that's a really important reminder. And I'm going to hand it back off to Gab to talk about the championship, I believe.
Yeah, before we go into the championships, sure. I have one other question on the trading side of things. So, Mark, you mentioned, the only way to avoid these, casualties of recessionary state economies is to have those quick cuts. And you mentioned even if you had cut at 10%, right, you would be up 80% that year. I'm also curious on the opposite side, at what point you start taking profit. And I'd be curious, I think that 10% might have just been perhaps an arbitrary number, or perhaps that is that number. Where is that number on the downside where you cut personally? And then on the opposite side as well, when do you start to take profit?
Okay, well, there's a number of things there that you just brought up that can go in a lot of directions here. So first of all, as far as the number, can you hear me?
Yes, sir.
Okay. As far as the number, and you said quick cuts. No, not necessarily quick cuts, or not even necessarily really, really small cuts. And when I say cuts, meaning, cutting out of the position, I think that's what you mean. Yes, so relative to your upside, okay, the math has to work. It's that this all comes down to math. At the end of the day, this all comes down to math. You have to make more on your winners than you lose on your losers, or you would have to be right many more times. If you're going to have a bigger loss than you have a gain, then you would have to have a very high batting average. Either way, those numbers, those are like three moving parts. I call it the trading triangle, like photography. You've got exposure, you've got shutter speed, f-stop, the triangle. Those three give you your exposure. Same thing with trading. Those are your three moving parts. Now, the number, the math, let's start with the math as far as the number. When you start getting into double digits, when you take a 5% loss, it takes about a 5.4, something like that, gain to get even. It's about apples to apples. When you get to a 10% loss, it takes an 11% gain to get even. It's still not way off. You're losing 1%. You get to 20, it takes 25. You get to 50, it takes 100. Or if you let stocks drop like some people have in this market and you're down 90%, it takes 900% to get even. And I don't know too many people who have too many 900% winners. So there is a mathematical number where no matter how good you are on the upside, it doesn't make sense to let a stock drop X amount. So that's the starting point, all right? So we found that that number is at 10% is where you start really going underwater. And if you can't get it right within a 10% range, then you've got a problem with your timing. Okay, these people, they say how good their research is. No, our research is the best. We're so smart. This stock's undervalued. And then they're down 60%. Your research isn't that good. Okay, if your research was that good, the stock would go up from where you bought it because your timing, obviously your research has nothing to do with timing. And okay, my time frame's long. So what? Your time frame's long. That doesn't mean anything. The stock doesn't know how long you plan on holding it. You're at a loss. So, and you're losing compounding time. So bottom line is that regardless of the strategy, you're going to have to do that math. Now, if your average gain is 50%, you could obviously weather a much larger loss than you can weather if your average gain was 5%, or if you were a day trader and it was a half a point. So that's the math that you have to, you're going to have to figure out. But there is some uncle points where it really doesn't matter because it gets to where you're at the point of no return. Let's see what else. I had another point, but I forgot what it was. I should have wrote it down, but it'll come back to me.
Might have been I know. Might have been on when you start taking profit.
Well, okay. So again, this is based on the reward has to pay for the risks. So again, you have to decide what type of strategy, what type of style, what type of approach you're going to use. Are you going to be relying on turnover? Okay, look, if I gave you a coin and I said, hey, you're going to get $2 on heads, you're going to lose $1 on tails. What is your goal with that coin? What would your goal be with that coin? To flip it as many times as you could, right? You want to flip it because it's a 50-50 proposition. You're getting paid $2 every time it goes on head. So every 2 flips, you're making $1. So I want to flip that coin as many. If in 1 year I can flip it 100 times, I make $50. If I can flip it 1,000 times, I make $500. So that's the goal. The goal is to flip it as many times. So you have to figure out if you're going to go for the big move. You're going to be a short-term trader. You're going to be some day trading scalper, and then from there, that's where you decide, what that gain is going to be and what kind of rules you're going to use. It's not just a one size fits all. Use the 50-day moving average. It doesn't work that way. But I can tell you this: the key to low drawdowns and the key to making consistent returns is to sell into strength. Okay. People say, well, I'll wait for it to go below the 50-day. Well, what if it runs up and it's 40% above the 50-day? You're going to let it come all the way back down and get below the 50-day and give all that up? You're going to have gigantic drawdowns. So it's not that simple. Selling at the strength, you're always at your equity high. Even though the stock may go higher, your equity is at the highest point. You're getting out at the highest point. If you keep getting out at the highest point, what would happen to your equity curve? It would be like this. It would be straight up. It would never have any downside. So that's the real key, is to get out when the getting's good and to sell into strength. And that will keep your drawdowns. That's one of the keys to keeping the drawdowns low.
Perfect. I'm very curious. So I'm just going to dig a little bit further in here. On the average day, is most of your trading happening during that first hour and last hour where the majority of the volume is occurring?
It's happening whenever the stock tells me to get in, and whenever it moves through the pivot point or my buy point. So I don't really have, in certain periods, certain markets, you'll have it where, everything's early in the day. And then there's other times where it won't be like that. You'll get a lot of late day. So it's more thematic. I can't say that over the years, I can say that it's always in the morning. That's just not the case all the time. Although it's very thematic. What I try to do, I look at the market each year as a 12-inning ball game. And I know I've got a long time. I've got a year to put down my return. So I'm never in a hurry. So in the beginning, I'm just trying to not lose money, okay? Make some profits so I can finance my risk going forward, so I can finance more aggressive trading, and figure out what's the theme. What's going on here? What's the technical theme? What's the overall theme? And what's the technical theme? Because sometimes you'll get For instance, 1995, I didn't start getting heavily invested till the market was in new high ground in April of 95. It was one of my biggest years ever. I was up over 400% that year. There was all power play high tide flags. I called it the year of the high tide flag. There was tons of powerful setups. So I saw this proliferating and they were working. And I just got super aggressive in all these power plays. You can go back to 1990, going into 91. That was the year of the big cup with handle. Matter of fact, Investors Business Daily had a front page. It said, "Cup with handles proliferate." That was their headline. And then they showed all these charts in the stocks and the news of all these cup with handles. It was Microsoft, Home Depot, Philip Morris. Back then, some of these were actually mid-cap names. They weren't big companies, believe it or not. And they were all breaking out of these big cup with handle bases. So that was a theme. Recently, we saw in 2021, the theme was pop and drop. At least that was what I called it. It was pop and drop. You had lots of stocks that came out of bases, and lots of them broke out and actually went for 1, 2, 3 days, sometimes 5, 7 days, and they go up anywhere between 5, 10, 15, 20%, but then they'd fall apart. So that was the theme. I latched onto that theme around February. And then by March, I really started to say, okay, this is the theme that I'm sticking with until it stops working. And that's how I compounded that big return. I'm going to tell you right now, my goal, my minimum goal, what I wanted to accomplish in the U.S. Investing Championship, I set out to make a triple-digit return. That was my goal. I said, look, if I don't win it, if I do a triple-digit return, at least it's super respectful. That's a huge return, and I'm still in the of doing what I've done in the past with those triple-digit returns. That was my goal. My goal, of course, I want to win it, and I thought I could win it, but I don't know. There's a lot of great traders out there. Some of them in that contest that I taught. So it was anybody's game, anybody's contest to win. But I latched onto that. For me, it was fortunate that theme was that rapid compounding theme that works great for me, and I was able to really compound those returns a lot throughout the year with big positions.
Perfect. And you led me right into the Investing Championship. So, Richard, let's bounce back and forth with questions on this. My first question is, how did you get involved with this, and why did you get involved with it, and what's been the experience?
You're saying the Investment Championship?
Yes, sir.
So back in the 80s, the U.S. Investing Championship was very prestigious, and it's making a comeback now, which is great. David Ryan, of course, won it 3 times. I went to a seminar and met David Ryan. I was very impressed with David and William O'Neill. And you would get your picture in the front of the Wall Street Journal. It was, like I said, it was a pretty big deal. Barron's back then, that was all you had. Wall Street Journal, Barron's, was a few publications. It wasn't like now where you've got 8 million outlets. It's no big deal to have your picture plastered on something and to be the featured in a story. Back then, it was huge. If you got featured in the story, only a very few people could. Because there were so few publications, only so many people could get featured in a story like that or on the front page. So I saw David Ryan won it 3 years in a row. And then, of course, I read David Ryan, Larry Hite, who was one of my main guys that I modeled a lot of what I do after, which he happens to be one of my very good friends now, and I speak with him all the time. He's one of the most wonderful men you ever want to meet. My goal was to be like that, be like those guys, my goal was actually to break their records. When I read Paul Tudor Jones in Market Wizards, I said, I want to break Paul Tudor Jones' record. That's my goal. He did 4 years of triple digits, and his 5th year was 99.4%. My goal is to do 100% a year average or 100% a year each year minimum for 5 consecutive years. And that's what I set out to do. My goal was to win the U.S. Investing Championship. My goal was to be the next Market Wizard. I never thought they were going to write another Market Wizard book. I didn't know that at the time, but I certainly wanted to be of that caliber. It just so happened that I ended up entering the U.S. Investing Championship in '97, and I won. It just so happens that Jack Schwager wrote another book and asked me to be in it, and the rest.
Just when we were getting to the good part. All right, I'm sure he'll be back on in just a second. This one did happen beforehand.
What's that?
We got you. We cut out for 10 seconds, but you're back.
Okay, yeah. So 24 years later, Norm Zeta, starts the contest, or when I entered, it was 24 years later. I guess 1997. I went back in 21. I entered against everybody's advice. Everybody I know said, "What are you, crazy? I mean, that's stupid. You have everything to lose, nothing to gain. You're already known around the world. If you're expected to do well. If you don't do well, they're going to say, see, it was a flash in the pan." So that made me want to do it even more. So I did it because I wanted to show nothing about me personally, but just to show that what I do is timeless. It's timeless, and that anybody can do what I do. If you read my books and you work hard, that it still works, and it's always going to work. It's never going to stop working, because the principles that I am teaching forward are timeless, and they're never gonna not work.
Perfect. So I think I'll ask the next question. So Mark, last year it seemed like you were trading incredibly aggressively. So I'd love to hear kind of the specifics when you would enter a position, how you kind of incorporated leverage into, right as the stock's going through the buy point. How do you use leverage to increase your returns, and what was kind of a typical position size for you to take last year as you try to concentrate into your best ideas?
Well, so very simply, progressive exposure I use not only on a daily basis, but also on an intraday basis. So let's say, in the morning I go into a few trades and they're smaller, but they're working, and I'm profitable. I might get more aggressive now because things are working, of course. So it's always on the heels of success. That's the main thing that would get me more aggressive, and also on the heels of success of closed trades that would maybe happen in previous days and weeks and months. So for instance, if I have a great week, I may be more aggressive that next week, or if I have a great month, I might start that next month being more aggressive, as opposed to, if I had a terrible month, well, I'm going to be going super, super light and just trying to rebuild very, very slowly, and try not to dig any deeper in the hole. So that's sort of the big picture around, or the big thinking around getting aggressive. At times, I mean, believe it or not, I wasn't aggressive that much as far as on average. On average, I was in smaller positions and in cash a lot of times. But when I did get aggressive, when things were working, I would take some really big positions. And when I say big positions, I was 4x leverage my whole account sometimes in one name. So, but the way I looked at it was, it's like with sports, professional sports, or the NFL. You have to take steroids, because the guy on the other side of the linebacker on the other side, the guy that's facing you, he's on steroids. So you can't compete unless you're taking the performance enhancing drugs, or you're going to get mauled. Well, when you get in a contest like that, you got to realize that there's guys that are willing to put their whole account in one name and shoot for the moon, and they might get lucky. And they might get lucky, right at the end, or or enough where it gets them such a lead. So you're going to have to be, super aggressive. It's like the Olympics. The competition is so tight that everything's got to be perfect, and you've got to be at your absolute top performance, because the difference between the winners are going to be tenths of a second. And that's how I felt. At least that was the respect that I gave the other traders.
Love it. All right. We have just a couple more questions here. How are we doing on time? Doing good? 5 minutes? Perfect. Okay. We're just going to do one more question
That's
each.
all. We're almost done.
I know. I could go all day. Twitter Spaces, though, we'll have you back. Hold them to it.
Thanks.
All right. I just have a couple more questions here, and I'm going to go with one because I know Richard has one that he really wants. And so we have a lot of retail investors in this room, and I think we go into this with an understanding that it's not the retail traders that are moving the market. We're playing that institutional game of the market makers. So to the retail investors who are in this room, a little bit of the parting words here. What's the general advice you have to them? It's not, I think a lot of us, the goal here isn't to become necessarily, the generational next, Elon Musk or Bill Gates from a wealth perspective, but rather, we want to be comfortable. We want to have some supplemental income. We want to be able to take vacations to Vegas, right? And maybe throw some money on blackjack. We want to be able to have a good time. What's your advice to retail investors approaching this market, this year with a mentality to try and be a winner?
Okay. Well, first of all, you said market makers. There are no market makers anymore. It's all computers. So don't think the market makers are out to get you, or there's some conspiracy, because that's ridiculous. They're the institutions. Yes, like you see now, the stocks are getting clobbered and having these giant declines. That's institutions unwinding big positions in some of these names that they've built up these big positions over sometimes decades and years and decades, and now running for the exits all at once. So that works on the upside and the downside. So the first thing is you want to get yourself, you want that wind in your sails. Okay. The first thing you have to realize is that you don't want to be going against that big money. So you've got to figure out how to identify when the big money, when the wind is in your sails, as opposed to when you're sailing into the wind. And I see a lot of people, they make these big fundamental cases, but they're buying stocks that are being sold by the institutions and are under incredible heavy pressure and distribution. And that's a tough way to go. But generally speaking, if you're new, the first thing is you've got to get the risk side down. You've got to realize that the key is to not lose. Winning big, I know it's fun and we all want to win big and we all want to trade a lot. Well, I don't want to anymore. I'm not that excited about trading like I used to be, but I know you just want to be in there and have action. And that's what kills you, sitting out and not losing money and being very, very meticulous with your buys. That's one of the first things. You got to be willing to do things that other people are unwilling to do. Whatever you hear everybody's doing is probably not the way to do it. And you're going to have to commit to a particular style or strategy and understand that there's one word that you have to come to grips with anything that you do in life to become great at. And that's the word sacrifice. You can't be good at one thing or great at one thing and be great at other things too. You could be maybe okay or pretty good at a bunch of things, but if you want to be really, really great at something, it usually takes everything you got just to do that. So, that's what I did. I made a commitment to a style, and with, we've been talking a lot about risk. When I finally decided, I drew a line in the sand and I said, this was in the late 80s. I said, I'm never, ever taking a big loss voluntarily ever again. If it gaps down on me, okay, then I have no choice. I'll sell at the next best price. But I'm never voluntarily taking a big loss ever again. If I'm going to lose at this, it's going to be one small loss at a time. They're going to have to nick me to death. And I made a commitment to that. I made a commitment to a style, a strategy, a certain method, and then said, I want to be the best at this particular style. My goal is to be the best in the world at this style, the best risk manager. My goal was never to make the big returns. My goal was to be the best risk manager and just expose myself in the areas that had the big potential. And I knew that the upside would take care of itself if I just took care of the downside. So, and the other thing too is that you got to realize, and this is one of the reasons why I do what I do, and I write books, and I stay doing this, and I spend so much time on Twitter. The reason why is because I didn't come out of an Ivy League school, and I didn't work for George Soros, and I didn't have mentors, and I didn't even have an education. I dropped out of school at 8th grade. I had no money to start off with. I had a very, very tough upbringing. So it's for inspiration. If I can do it, anybody can do it. And that's the real key. You have to believe in yourself, because it's going to lean on your Achilles heel, your emotional Achilles heel, like you never saw in your life. And, and maybe some of you guys had a really good start in a bull market and you think this is easy. It will destroy you and rip you apart emotionally, financially. This is a serious game, with people like me on the other side of the trade, with professionals, in the same arena as you, vying for those dollars. So you've got to believe in yourself and stick and know that if you stick with the discipline and you work on specializing and perfecting something, that you eventually can be great at it. But if you're all over the place and every time you have some problems, you lose faith and you try to find the holy grail, and you're always looking for the best, bigger, better deal and the hottest deal, you're going to be a jack of all trades. You're never going to be really great at anything, and you'll never accomplish anything really great. And that can go with anything, whether it's sports, trading, business, doesn't really matter. That advice is universal.
Perfect. You just kind of stole my usual final question, but I'll finalize with this, Mark. What kind of resources would you recommend traders who want to learn more about your style? What should they look? What books should they read? Where should they go? What videos? What kind of advice do you have on that regard?
Well, certainly depending on the style that you want to, that makes sense to you, something that, you want to make sure that whatever you're doing makes sense to you, that you could have some faith and belief in, at least from conceptually. So, if you're my style, of course, I have books that you can read, and William O'Neill's books are homogenous with my books. If you read O'Neill's books and my books, it's like volume 1, 2, 3, 4, and you're on the same field. If you're reading Warren Buffett's books and Ben Graham and things like that, and then trying to marry that with something like I do, you're going to have problems. So it depends on your style. I think, if you want to do the type of style that is a growth style, more momentum, more of the type that you can turn over the edge and have the consistency, I would read just my books and O'Neill's books and read them over and over and over and over, as opposed to reading lots of books. You might want to read lots of books just to be well read and to have good conversation at parties. But if you really want to learn how to do this right, you need to get focused. There's tons of resources on Twitter and all kinds of, I know there's 8 million mentors now, and everybody is a mentor, and everybody's got some type of channel or a program, but there's some really good people out there, really, really great people that have some wonderful things to share. You just got to find it and see if it makes sense to you, and make sure they've got a track record, or they've got some success. And again, it doesn't mean that you might get a coach that he's not a great trader, but he's a great coach. And I said this one time on Twitter where I said, I don't ever listen to anybody who's not successful. And people are like, well, that doesn't make any sense. This guy was a great basketball coach, but he was never a great basketball player. Yes, but before I listen to him, I want to make sure he's a great coach. Yeah, see, if he's a great coach, he's got to prove that to me. If he just coached a team to the NBA Finals, well, now I know he's a great coach. So it doesn't necessarily mean a trader has to be this great trader, but maybe he's coached great traders. Maybe they've got a track record of having a real great program. So that's another way that you can maybe evaluate someone that can help you.
Love it. All right, I think that's pretty much our time for today. Mark, anything else you want to share with the crowd?
No, I mean, whatever you guys, I could spend as much time as you want. I'm just trying to help you guys, and I hope this has been helpful for everybody. I can't see the audience. I hope you got a big audience, and you're having a great event. Like
they're watching intently.
there, and I wish I could be there and hit the poker tables.
Love it. Awesome. Richard, anything else you want to say?
No, I just want to say, everybody, let's give a big round of applause to Mark. Thank you so much.
Great. It sounds like you had a good crowd there. Have a good rest of the event. And
you heard him, ladies and gentlemen. Have a great rest of the event. I believe next we are going to have Phil Davis coming on stage. I think we might have a small interlude in the beginning. But yeah, hope everyone enjoyed that. One more time, give it up for Richard, Moglen. There we go. Thank you. I'm Wolf. Appreciate you all, and we will chat with you with the next speaker once they are up here. Thank you. All right, everybody. I hope y'all enjoyed that speech from Mark. And now it is time to learn how to make time decay your best friend. With that being said, let's welcome to the stage Phil Davis from PhilStockWorld. All you good, sir.
All right, thanks. All right, thanks, guys. Hope everybody's having a good conference. Let's see. Don't drink that one. Okay. All right. I was told to look for a clicker. Here's a clicker. We're in good shape. All right. So there we go. That's a good slide. All right. How many people in here do trade options on a regular basis? That's how we're doing amateur stuff. If there is about half of you. How many people sell options? All right. Looks like most of the people who trade options sell options. We're going to talk about why we sell options, how it's going to improve your performance, and how to mitigate your risk. So what I'm trying to do here is to tell people how you can buy stocks for a discount, how to enhance your dividend returns when you have dividend stocks, or even any kind of stock you can add a dividend to, how to conserve your cash, hedging, and how you can turn winning trades in up, down, and flat markets. All right? The principle is very simple. We're in a casino. The casino is here because thousands of people every single day come into this casino hoping to make money. All right? And they play games. And the games are supposedly games of chance. But the fact is, the people who own the casinos make billions of dollars. The people who gamble in the casinos, most of them lose, some of them win. But the reality of the system is it's statistics. It's not gambling. Okay, the casinos are investing in this building to attract people to come and gamble. What they're using is proven statistical models that pretty much guarantee their success over time. The more people that gamble, the odds are in their favor. So individual players may win and lose statistically, but there's a house advantage. And the owners of the casino know that the more you play these games, you will eventually lose. So they will do whatever they can to bring you in and get money on the table and get people gambling. That's the whole point of this thing. The more you play, the more they win. They'll give you entertainment. They'll buy you drinks while you're playing, whatever it takes. They'll even fly you back to the casino in case if you win money. If you're a big winner or a big loser, as long as you're a big spender, they'll do it. They'll fly you to the casino, and they don't care whether you win or lose as long as you're playing. All right. Now let's take, for example, very simply. I don't want to spend too much time on it, but look at roulette. There's 36 numbers on a roulette table. And there's a 0 and a 00. That's 38 numbers. Yet, if you pick a number, if you pick a number, what do you get paid? You get 35 to 1. You don't get 38 to 1. You get 35 to 1. Where does that extra 3 go? That's the house advantage. The house advantage is 3 into 38. It's practically 10% house advantage. The thing is, you don't notice it because you only pay the 10% when you win. Because instead of getting $38, you get $35. So you feel great you won $35 because you hit your number, and the dealer feels great because he only paid you $35 instead of paying you $38, which is how much you should have been paid for the risk that you took. And the more times you play, the more times he makes 3%. Doesn't matter whether you win or lose, because statistically, all the people playing, those odds over time just become a steady stream of income for the house. And every game in the casino is like that. Roulette's probably the worst. But that's happening all the time when you play. So logically, it's very simple to understand. You know, if it was heads or tails, if it was a 50-50, right? And every time you won, you got $1. Every time you won, you got 95 cents. And every time you lost, you lose your $1 on every bet of heads or tails. What's going to happen to your money after a while? You're going to lose. It's going to get eroded away over time. If you keep playing, you will lose, because eventually the odds even out. You end up with an even amount of heads and tails. But every time you win, you're losing a nickel. Now, you may enjoy it. It may be a fun game. You may have a great time. But the bottom line is you're spending a fortune that you don't really realize when you're playing these games. The odds are always in the house's favor, always, every time they play. And this isn't gambling. It's a mathematical fact. It's a law of the universe. You can run it 1,000 different ways in computer models, simulations, so on and so forth. And this is just the way it works. So, why don't we use this model and apply it to our investment? Why should we be the gamblers when we can be the house and there's nothing that stops us? Okay? The things that Goldman Sachs does, the things that JP Morgan does, we can do the exact same thing as they do. And there's no barrier to entry, and very few people understand this concept. All right? So, when you want to, by the way, I was told I was originally going to do this about retirement accounts, but they said that most people here are not retirement people. They're a younger crowd. I see you are a younger crowd. I imagine it's probably from COVID, because when I used to hold conferences here, and we'd skew a bit older. But the question is, while you guys may not be super worried about your retirement yet, how many of you guys are worried about your parents' retirement account? Not too many of you? That's good. No, I got to tell you, because I mean, they're not keeping up with inflation. And I see a lot of my mom's friends are digging into their retirement accounts. They're not getting the returns they hope to get, or the returns they're getting, which are maybe, 6%, 8% if they're lucky on in these Schwab accounts, or the what's up, people, Raymond James, things like that. They're just not good enough anymore. They don't keep up with their rent expenses. They're not keeping up with the food expenses. And God forbid, then you start dipping into the principal, and it becomes worse, because now you're eating away, and now even the 6% isn't enough anymore. So, as you get older, things like this become critical to you, and as inflation eats away at people's accounts, this is something that you can carry forward to a lot of situations. It is very simple and very safe. All right. So when you own a stock, it's like owning the casino. You have an asset, and now you have to figure out how do I make money using my asset? All right. There's obviously you're thinking the stock is going to go up in price, and they do. Sometimes they do. Sometimes they don't. But there are people who would like to use your asset. There are people who want to buy options on your stock, and some people want to bet it's going to go down. Some people want to bet it's going to go up. But they'll all pay you a premium to make those bets. Okay? That's a huge thing, because the only absolute function in the stock market universe is that all premium expires worthless. All of it. Every time, 100% of the time, the definition of premium is that it is the amount of money you pay over the strike. And now, you may win or lose on the strike, but the premium itself is gone over time at the expiration date of that option. Even if the option is higher, it's not the premium you're paying, it's the intrinsic value that you're paying that might be a loss. But the premium, gone. Every single time you will collect that premium, you will keep that premium. So a person who's buying an option contract, they don't own the asset, they're just renting it from you. And they are assuming more risk than you are assuming. They're attracted by the potential to have returns. And most of you guys use options, but let's just be very simple about it. If I have Apple's $145 right now, and a person is willing to pay me for a January $150 contract. So Apple's at $145 now, and they'll pay me $15 for the January 145 call. What does that do? It gives them the right to buy Apple from me. They're renting my stock for $150, $5 more than it is now, between now and January of next year. Okay, between January coming up. They're going to pay me $15, or about 10% of my stock's value, for the ability to buy the stock from me for that. Now, what are they betting? From their point of view, for just $15, they're controlling my Apple stock. And they may think that Apple's going to go back up to 165. So if Apple's at 165 and they have a 150 call, they're going to make $15. That's what they paid. So they're going to hope it goes over 165, frankly. But they're going to leverage that $15, and anything over 165 is profit for them. So if it goes to 180, they're going to make $15. They'll make 100% on their $15. What happens to you effectively is if you sold the right for them to buy your Apple stock for 150, they're going to give you 150, and you're going to keep the $15 that we talked about, the premium value that we put on the stock. So that's $20 you get back off your 145. Now, the reason people don't like to sell options is because you could have made more. You could have sold your Apple stock for 180. But that's a bad way to think about it, because you're definitely going to get back 160. 165. You definitely get back 165. The thing is, people think that they're limiting their upside, and you are limiting your upside, but you're limiting your upside in exchange for getting 10% back on your stock now. Now, if you get 10% back on your stock every year for 10 years, that's 100% back. Now, if you think back on your portfolio and your performance over your lifetime, would 10% a year have made a difference to you? You can correct a lot of mistakes doing that, and there's more to it. So doesn't it make sense to be the house, is what it's saying here. So when you own a stock, you've got an asset people want, and if you consistently take those wagers over time, you will consistently buffer your performance. So if the stock goes down, what happens if Apple's 145, I sell the $150 call for $15. I collected 10% of Apple's current price. So now if Apple drops to 130, I keep the guy's $15. He's got no use for it. I keep the guy's $15. I'm going to keep it no matter what. Any and all situations, that $15 was paid to me. He has until January to buy Apple for me for 150. If Apple's under 150, he's not going to buy it for me for 150. It wouldn't make any sense. If it's over 150, he'll buy the stock from me for 150. But I get the 150 plus the 15 he gave me in the first place, 165. So Apple's at 145 now, and I'm effectively saying I'll sell it for 165 between now and January. That's a let's call it 15% bump in the price. And if I do that every single year and make 15% a year, that means every 6 years I double my money. Very, very simple concept. Doesn't hurt me at all. Don't have to sell all my stock. Every option contract is 100 shares. So I don't have to sell all my stock. I can sell a quarter, 10%, 20%, 30%. It's going to enhance my total return. And it buffers you in case it goes down. And if it goes up, unless Apple does go up more than 10%, I'm still going to make more money than I would have made. Oh, and by the way, if Apple does go over 150 and you're worried you're going to get your stock called away, buy more stock. Not a big deal. If you feel strongly Apple. Oh, I'm sorry. There's another thing you can do. You can buy back the contract anytime. Not for $15. The value of the contract goes up as the stock goes up, but you can terminate the contract at your discretion. Which is amazing, really, because you think about it, this casino can't watch somebody playing blackjack and see the chips piling up and go, okay, buddy, you're done. But that's what you get to do when you sell an option contract. You can cut that person off at any time if the situation changes. Let's say it's a Lockheed Martin and they lose a contract. Or let's say it's Boeing and the plane crashes, okay? You may want to, for whatever reason, cut an options contract and say, okay, I don't want this guy with an options contract anymore. You're allowed to do that. You can sell more, you can double down, you can do whatever you want with these things. It's at your discretion, and that's another huge advantage. That's a more advanced concept. Okay, so what we do is we call this system at PhilStockWorld getting rich slowly, because we're not teaching people to win. Mark's thing before the presentation was in this room just before me. Great trader, great fundamentals. We agree with everything he says. We do allocation blocks, what he calls scaling in. We do a system called allocation blocks. And the point is that but the only difference is we don't go for those gains and gains and gains. Okay, we try to lock in a pretty steady 20 to 30% gain on an annualized basis, and we do it by selling that premium both on the put side and the call side. So in other words, like I said about getting 15% on the call side, I can get 15% on the put side too. So if I combine those and pick up 30% more on my stocks every time, as long as I'm managing my position size, we're going to get a consistent return in a flat market. This is the greatest thing about it. In a flat market, we make the same money. In an up market, we make the same money. Now, every once in a while, there's a year like the last couple of years when the market goes up 50%, and everyone's like, oh, son of a bitch, why'd I sell those calls? Obviously, everybody wants to make the maximum possible. But last month, when the entire market dropped about 20%, all of our guys were sure glad we all sold calls on those stocks, right? We were thrilled because all those people expire worthless. You know what else is fun? If I sold in January the Apple calls for $15 and Apple drops 20%, those calls go down to like $7, okay? I can now buy them back for $7, wait for Apple to bounce back, and then sell them again to somebody else for $15. Now I collected $22. See, that's, you can use all this to your advantage. You can still do market timing. It doesn't really limit you, okay? It limits you in a huge gaming market. And honestly, out of every 20 years, there's maybe 3 or 4 years where we go, wish we hadn't done that. But that's completely washed out by the times like we're going through right now when the market drops tremendously. And what do we have? We have a pile of cash that we collected up front from the people we sold premium to, and we get to keep it and use it to buy more stock while it's being sold at a discount. We have this other video, 7 steps to consistently making 30 to 40% annual returns. Stock selection is also very important, okay? We are, at PhilStockWorld, we're not option strategists. Option strategists are people who look for like the little flaws in the option pricing and say this option's overpriced, this one's underpriced, this one is accounting for that. We don't care. What we are is we are fundamental investors who use options to enhance our performance. We use it for leverage. We use it for hedging. And by doing that and using picking good, sound, fundamental stocks. And by the way, we are mostly blue chip traders. We do not play a lot of momentum stocks. We don't go for weird stuff. Our trade of the year this year was IBM. Our trade of the year before was Barrick Gold, GOLD. Pfizer, Apple, Bank of America. Those are our trades of the year when we do trade of the year. And for us, the trade of the year is, now, IBM's interesting. The trade of the year for us is a stock that's going to make, where we can set up an option play that's going to make 300% or more over the course of the year with the most certainty. And this year it was IBM. What happened we picked those trades in Thanksgiving for the next year. This Thanksgiving, IBM was down around 115. And the way we played IBM was that 115 was our goal. We weren't playing IBM to go up. We were playing IBM to be over 115. We don't care how much over it is. We just want it to be at 115. Yet we still make 300% the way we constructed the options trade. It's not that hard once you learn the fundamentals and how to make them work for you. Here's how we buy a stock for a discount. AT&T is 1975, or it was on whenever I made the slide, Thursday or something like that. So AT&T is 1975, and rather than buy the stock, and this is how we generally will enter our positions, we set up a watch list for our members. So we've got a watch list of a dozen stocks that we'll be looking at in the immediate, like for the quarter, that we're watching closely, that we think have hit fundamental value levels that we find very attractive. I'll tell you, right now there's Moderna, there's Paramount, used to be Viacom CBS, it's now called Paramount. Boeing is another one, been really hammered lately for no. Boeing is insane because Boeing has 7 years of backlogged orders. And Boeing took a hell of a tumble Friday. It dropped 10% Friday because the book they submitted to the FAA the FAA sent it back and said, you didn't do this right, you didn't do that right. Out of a 300-page document, there was a couple of things missing that the FAA wanted included. They sent it back. This happens all the time. These are real complex, major things. So for certification on the 787, people drop the stock like the plane crash. And now that happened very quickly, and very quickly buyers came in who were smarter like me. I'm saying to my members, I'm like, this is bullshit. Like, this is a real stupid reason to drop Boeing's price. And it took down the whole market too. So the whole market was doing good, and Boeing happened, and everything crashed back down. Then everybody started buying again when they realized it was nonsense. But I mean, the markets are insane when they react like that too. But the bottom line is on Boeing is they've got 7 years of backlogged orders for as many planes as they can possibly produce. They are, when they were before the last cycle, and again, cyclical companies, by the way, are great. People no longer like cyclical companies. People dump out of cyclical companies in down cycles, which is exactly when you should be buying them. Boeing is essentially a cyclical company, not because planes get bought in cycles, but because when they have a cycle of developing new planes, which they're in now, they spend tremendous amounts of money on R&D and so on and so forth, and it crimps their production. They have to redo their lines. They spend huge amounts of money on infrastructure, and that's a cycle they've been in the last few years. So they haven't made much money the last few years. But if you go back before the cycle started, when they were finishing up the 747s and the what were the ones before, the 727s or whatever the smaller planes were, when they were finishing up their smaller plane line in the previous cycle, they were making $10-15 billion a year. Excuse me. So now they're making $5 billion a year, but they're going to start making 10 and 15 billion as soon as they get the production ramp back up, just like Tesla. When they ramp their production up, they make more money. People don't have the patience for it, though, so everybody's dumping out of Boeing. Fantastic value there. Anyway, not the point, just something aside. But AT&T also ridiculously undervalued. They just spun off Warner Brothers Communications. But the remaining, first of all, they spun off Warner Brothers Communications and got some large billions of dollars. I forget the number, but many billions of dollars that went towards paying down their debt load. And the basic company itself is, of course, AT&T. I mean, they're unkillable. We tried to break them up years ago, and they just came back. So rather than buying the stock at all, though, you can just sell the 2024 $17 puts for $2. Now, what am I saying there? If I sell a put, I'm renting somebody else's stock. I'm paying somebody. I'm sorry. Somebody's going to pay me $2 to guarantee that I will buy their stock for $17 in January 2024. That's what a put option is. Okay. Most people buy put options. We sell them. Why do we sell them? Because I am willing to own AT&T for $17 2 years from now. I'm very willing to do that. Not only that, but my net is $15. The 25% discount to the current price, basically, because I collect the $2. I either keep the $2 if AT&T goes up. I'm obviously not going to be able to buy it for $17. But if AT&T goes down and I have to buy it, I buy my entry on my first transaction is going to be $15 a share. I have no problem with that. I will make that promise any day. And that's what we do. We go through our watch list, and when something dips a little bit lower and becomes super attractive, we say, you know what? I will buy Moderna. Moderna's down to like $56. I tell you what, if it goes to 40, I'm in. Pay me $10. It sounds insane. It's like if you're selling your Toyota, that's a used Toyota for $20,000, and a guy says, I tell you what, I'll buy it for $15,000 if nobody else wants it. You pay me $2,000. That sounds crazy. You're not going to do that, right? Yet, options traders will do that all the time. Now, there's a reason they want to do that, because somebody's making a major purchase of AT&T. They want to limit their loss to no more than 25%. Therefore, they pay $2 for the puts. And you know what they do a lot of times? They'll sell calls on the other side to make that $2 back. So what they're doing is just playing it for the dividends over the next 2 years. You know, people are very happy. This big institutional traders are really happy making 5% a year, 10% a year. They're thrilled. And AT&T is paying like a 6-7% dividend. Big institutional traders love this kind of stuff. So they'll take puts to hedge their downside, but they're going to pay for the privilege. I'm going to be the guarantor saying I'll do that. In fact, Warren Buffett, when the S&P was totally crashed out in March 2009, Warren Buffett sold $5 billion worth of puts on the S&P 500 for if it dropped another 20% or something like that. What happened? Well, the S&P bounced back, and Warren Buffett kept $5 billion. He didn't get to. He would have been thrilled to buy the S&P if it had dropped, but it didn't drop. You know, he was the guarantor of the S&P for somebody, and the guy who bought the S&P, who bought SPY or whatever he did, the guy who bought it and paid the $5 billion, boy, did he get his money back, because the thing doubled by then. So everybody won. Warren Buffett got $5 billion, and somebody else doubled his money. But what gave him the balls to double his money was taking the put options, was buying those put options, saying, I can't lose more than this. I'm limited. And that's what put options are for. But when you sell the put options, what are you doing? I'm agreeing to buy a stock for a lower price, and you're going to pay me now cash for that promise. I will never have to give you that cash back ever. The only thing I ever have to do is buy the stock, and the only reason you're going to buy the stock is because they force you to, and they'd only force you to if AT&T is trading below the strike price, which is 17. Now, that means what happens in our portfolio? It means we end up with a lot of put options that never trigger. But that's one of the reasons we put them out of the money by about 20%, because they're out of the money by 20%. Most people, if you have a portfolio margin account, how many people have portfolio margin accounts? Okay, so you need at least $100,000 to have a portfolio margin account. But when you have a portfolio margin account and you're trading blue chips like AT&T, they probably only require 20% holdback on your stock. So you're going to have a very, very tiny margin amount taken out for this sale, because it's so far out of the money, your net 15, that the broker doesn't consider it very likely that it's going to trigger. Therefore, they will not require very much margin, maybe $2,000, $3,000 of margin, and you're going to collect $2,000 in cash. So there's not much damage to our portfolio holding those positions, and we have several put positions. In fact, we'll usually add in a portfolio like one a month. Every month we try to sell something and bring some cash in. Now, if I have a $100,000 portfolio and I sell $2,000 a month in options, that's $20,000. There's 20% of my portfolio right there, 25% of the portfolio over the year on stocks I may never buy. But I'm promising to buy them if they get cheap. You also need to have hedges in case we actually do have a crash, but that's a whole different lesson. Anyway, so here that just basically says what I just said. So I'm not going to get into it here. Now, how do we enhance our dividend returns? Well, AT&T pays a $1.11 dividend. So again, if I'm getting it for net 15, that's a big chunk of change that I'm getting in dividends. We can also, though, be much more basic about it. We can buy, now this goes back to your mother's portfolio or whatever. We can buy 1,000 shares of T for $19,750. We can sell the $17 puts. So I'm promising to buy another 1,000 for net 15. And we can also sell calls. In other words, I'm going to sell somebody the right to buy my stock for 20, which is where it is now, basically. And they'll pay me $2,100. What does that do to us? Well, that drops our net cost of the whole transaction to $15,650. We're going to collect $1,100 for 2 years, which is $2,200. So our net cost ends up being $13,450 for 2,000 shares of AT&T. That's our worst case. I'm sorry, our worst case is we get assigned 1,000 more, and our cost will be 30,000. Sorry. And our average would be $15. So our worst case is still $15 a share for AT&T. But if AT&T is over 20, we're going to get called away with a 48.7% profit on a basic conservative dividend stock. So your mom, instead of getting 6% back on the bullshit she's holding in a portfolio, can get 20% back a year. And instead of having her retirement account diminish year after year after year, it can actually expand and pay out the dividend she needs to live on. That's really important. And it's important for you too, because you know what? If every 2 years you get 48% back on your stock, how long does it take before you have free stock? Nobody? Come on, 4 years. Okay, 4 or 5 years, you follow this kind of strategy, and there's hundreds of stocks that we do this with, hundreds. Okay, we select them very carefully to be the kind of stocks like AT&T. First of all, if you can't close your eyes and picture, if you can close your eyes and picture any scenario in which this company won't exist in 20 years, it's out. We don't want it. All right, but it's AT&T, it's Pfizer, it's Merck, it's Hewlett-Packard, it's things like that. I mean, you know, we're picking stocks that have a 100-year history going back and don't see any reason why they're not going to have a 20-year history going forward. These are things we're going to want in our retirement portfolio. Very simply, though, if you have $100,000 and you do this and you follow this strategy, and again, in the simplest manner, because I'm not going to talk about the fact that you're obviously reinvesting along the way. You don't just wait 5 years until you reinvest. But if every 5 years you get all of your cash back, then you buy another round, and then going forward in 5 more years, you're going to have 2 times the stock getting all the cash back on 2 times the stock. So now you've got double the cash that you started with and 2 times the stock. And then in 5 more years, 4 times the cash, 4 times the stock. And in 5 more years after that, 8 times the cash, 8 times the stock. So you're going to be 16 times where you're starting. So $100,000 in 20 years. And again, it's 48%, it's really more like 4 years. But just using a 5-year payback cycle, you're talking about having $1.6 million after starting with $100,000 in 20 years. So is this a good way to invest? Generally, yes. Okay. Is it a great way to retire? Generally, yes. And you don't have to do this with your whole portfolio. Do it with part of your portfolio. But some of it should be invested in a conservative returning strategy that's going to guarantee you a comfortable retirement. Okay, you shouldn't be playing like gambling with all your stocks. It's fun to go shoot for the moon and pick the momentum stocks and do this and that. But if you can make 16 times your money in 20 years following a super conservative strategy like this, why not do that? You know, and please at least, you know, give it a chance. I understand how slow and tedious and annoying it is because it doesn't seem like you're going anywhere in the first few years. And you're like, why am I tying my money up in this thing? Why am I keeping the strategy? But once you get to that 5th year and you realize you have all the money you started with from the initial investment, you still have the stock, and now you can invest in 2 more stocks that you can pick up. And again, I'm not saying do this, don't have 16 times AT&T, but just keep doing the same thing with dividend stocks and diversify it. And all of a sudden you've got this portfolio. If your portfolio is paying even 10%, and it's $1.6 million, you started with $100,000, and 20 years from now you're being paid $160,000 a year. And the other great thing about stocks, they go up with inflation, right? With inflation, not all stocks, but again, pick the blue chip companies, pick the ones that go through all sorts of environments, pick the ones that have already survived the 87 crash, the 2000 crash, the 2008 crash. These guys have all been through this before. They've all adjusted. Procter & Gamble's still going to sell cereal. Toyota's still going to sell cars. You know, things like that. It's very simple things that you can pick. And if inflation hits, they're just going to sell them for more money and make more profit. That's all. It's happened before. This isn't the first time. You know, the Fed funds rate in 1987 or something like that was 22%. People are whining and screaming about the Fed funds rate going to 5% this year. It was 22% the last time we tried to fight inflation. This is nothing. But, you know, a lot of these stocks aren't prepared for this sort of thing. Stocks that borrow, look at, and watch your balance sheets. Make sure your stocks aren't heavy debtors. They're going to be paying a lot more in interest. That's a fact. You know, take these things into account. Now, speaking of which, if you want to conserve your cash, we can blow off the dividend on AT&T. And here's a trick. We can buy the 2024 $15 call. Now, keep in mind, AT&T's $19.75. On Thursday, the 2024 $15 calls were $5. I'm paying 25 cents in premium for the AT&T $15 call. So so in other words, I have the right to buy the stock for $15. I'm paying $5 for that right. That's net 20 to me. The stock's at $19.75 now. So what have I done? I've effectively bought the stock. The reason it's so cheap is because I'm screwing myself out of the dividend. I don't really own the stock. I own the right to the stock. I don't collect the dividend along the way. That's why it's cheap. Any large dividend stock will have very low premiums on long-term calls. But somebody who wishes to buy the stock is going to pay me $2.10, all premium, because it's out of the money. He's paying me 100% premium for the 2024 $20 call. Now, if I combine that with selling the short puts at the price again, where I said I'd be very willing to buy AT&T for $15, I sell those 10 of those for $2,000. Now I'm spending net $900 on a spread that is a $5,000 spread. So between 15 and 20 on 100 contracts is a $5,000 spread. And in 2 years, I can make $4,100 or 455% profit on my cash. That's against my risk of buying AT&T for $15, but it's $15 plus the $900 I lose on that spread. So it basically be $15.90 becomes my worst case scenario for owning AT&T. So my worst case, I'm sorry, 17. Sorry, getting assigned to 17. My worst case is $17.90, which is $2 off the current price. And my best case is I make $4,100 profit, and I'm only committing $900 for that trade. That's the aggressive way to play. If you feel very strongly that AT&T is far too low and you just want to do that now, $4,100 is probably double the dividend. So instead of bothering with all this AT&T and selling calls and selling puts and whatever, you set this trade up, and I'm going to make twice as much money as if I had the dividends, committing only $900 in cash. That's fun too. But the whole key to this thing is you're just putting the odds in your favor. Every time we do these trades, we sell the premium, it puts the odds in our favor. We're not gambling. That premium will expire worthless. All we have to do is manage the underlying trade, which is what you have to do anyway when you have stocks. It doesn't change anything that you're doing other than the fact that you basically opened up a rental company. Okay? It's like if you have a ski house and you use it. You know, if you sit there and say you have a ski house and you go up 3 times out of 2 months, you go skiing. Okay, so there's 8 weeks and you go up and use 3 of them. 5 weeks it sits there empty. So suddenly you have the clever idea that, hey, for five of those weeks, I can rent the place out for $2,000 a week. So what are you going to do? You're going to get $10,000 more over 2 months. For doing what? For doing nothing. It's the same house you had anyway. You're getting the same use out of it you were getting in the first place. All you've done is given people 5 weeks or let other people use it for 5 weeks. And in this case, nobody's going to steal your TV set or anything like that. You don't have to worry about that. It's a stock. It's not like they're going to break in. And what's the downside? Same downside you have with a ski house. What if I want to use it in another week? What if I want to go up for next week? You can't. You rented it out. That's the same thing as what if AT&T goes to 25? Well, tough. You sold it already. But while it's going to 25, you could easily change your mind, buy back the short calls, or just buy more stock yourself. There's a million ways. In fact, don't forget, it only cost $900. So, you know, let's say you put yourself in a position where you're going to get called away at 20 and AT&T crosses over 20. I can execute this spread for $900. out of all the money that people paid me already, I'm still going to collect my money on AT&T, which was $6,550 profit. And all I have to do is put this trade on with a stop, and I'll make an extra $4,100 profit if it keeps going up. So very easy. I can easily get into a different trade. This spread, I'm only putting $900 extra into it because I suddenly get nervous that AT&T is going to go flying and I'm going to miss out, and I can do that. Once you understand these strategies, and these are the really basic building blocks of what we teach people to do. But once you learn these strategies, it's tools in your toolkit that you don't have otherwise, and it becomes like really second nature. Like, oh, I can do that, or oh, I can do that quick, and you figure it out. So now you've got your own stock market casino. You're getting paid constantly. People are clamoring to give you money. People are lining up to give you cash and pay for you because you've got stocks that they want to trade in. By the way, another good reason to be in blue chip stocks. Many, many more people want to buy options. We can apply these principles to hedging, which we do, of course. That same leverage of this kind of leverage on AT&T, we can apply this to SQQQ, which is a triple short on the NASDAQ. It's an ETF. And if we apply this kind of a strategy, which pays 455% to a 3 times ETF, then we are hedging the hell out of the NASDAQ. So if we have a bunch of NASDAQ stocks and we're worried that they could lose $50,000 if the market turns down, and don't forget, what does losing $50,000 mean to us? It means we get assigned a bunch of stocks at a very cheap price, and we're forced to buy them, and even then it's still down. But the market would have to be down like 40% before that happens to us. But if the market goes down 40%, what's going to happen? Well, I put 10% of my money into something that's going to pay me 450%, and that's going to give me 45% of my portfolio back in cash to use to buy the stocks that I'm forced to buy if the market drops 40%. So simple things like that are hedging strategies, and we do those. We hedge everything. We're big hedgers. Because you never know. You never know when something's going to happen. You never know when Coinbase is going to drop 90% on you and things like that. Who's the other ones that went crazy? Oh, Peloton dropped like 75, 80%, whatever. It's like just insane stuff happens. But again, we did play coin. I have to tell you, we played coin because I was like, if Bitcoin ever does, I'm not a crypto person at all. But our hedge, in case I'm wrong, was to have Coinbase. And I said, well, if crypto really takes off, then Coinbase should do well. No. So it's a dead hedge, basically. Peloton, though, that's not the kind of stock we buy. We just watched it happen because, it's a momentum stock. It's new. It doesn't have a track record. We don't know how they handle adversity. And now we know. They don't handle adversity well at all. So when you combine these techniques, and this is the key to a good casino, right? They've got lots of games. You don't have a casino that's all craps. You don't have a casino that's all roulette. They have lots of games because the more diversity they have in their games, the more the statistics work for them. They want lots of people playing lots of games where they have a house advantage, and so do you. All right? And that's what it looks like. You've got people playing everywhere, all sorts of different things, and statistically that your portfolio is going to be just generating cash on a regular basis. It just comes in every month, more and more cash drops to your bottom line. And that's what being the house and not the gambler is. That's the whole principle of what we teach. And that's it. That's it for the slide part anyway. So does anybody have any questions or anything that would be helpful to clarify? That's it. All right. Yes. In a retirement account, well, first of all, there's a couple of tricks to that. In a retirement account, you can sell covered calls. In a retirement account, you can buy a bull call spread. Okay. What you can't do is sell the puts. So what you do is you set up a separate account to sell puts is one possibility that you can do, or you just don't do that part and we stick to the covered calls and the stocks with the covered calls or a bull call spread in the retirement accounts, if it's an IRA or 401k, something like that. But like with my mom's account, I took 1/3 of her account and turned it into a regular account and used that for put selling. So When she enters a position, what happens is if she's obligated to buy something, she then buys it. She cancels the contract in her main account, buys the stock in her retirement account, and then when the stock goes back up, she's getting tax-free money in the retirement account. So basically, just shuffle it around. You're not, again, you have to think outside the box. It's like your money isn't stuck. There are tax implications, of course, taking the money out, but your money isn't stuck. And of course, my mother, because I've been doing this my whole life, never had all her money in a IRA. But the money that's in the retirement account is retirement money under those restrictions. The money that's outside the retirement account is gambling money. And the nice thing is, oh, by the way, don't forget, if I do it that way, she's taking the loss in her open taxable account and taking the profit in her retirement account. So it's really a nice, fun way you learn to play with these things and make it to your advantage. Yes. Assignment property. Mm-hmm. It's funny, everybody always worries about being assigned, but you have to be so deep in the money before you get assigned something. It just doesn't happen that often. If there's even a smidge of premium left in the option that you sold to somebody, they're not going to cancel a premium. Why would they? It doesn't make mathematical sense to them. So generally, we don't get assigned, and we will almost always, as it gets to 5%, 10% premium left in an option, we'll usually do something with it. We call it rolling. It just means rolling. It just means close it here and open it there, change another one. And we'll move it to something that has more premium generally. In a drastic case, you have to let yourself get called away, though. Something gets last higher. We had Wheaton Precious Metals, which is a silver and gold trading company. And Wheaton Precious Metals was also a stock of the year for us, actually, a couple of years back. And they took off. They just blasted through our numbers and all that. And we just were like, oh, well, what are you going to do? We took out 300%. And we're like, oh, well, we'll take the cash. I guess we'll go away now. It went so far up that it wasn't worth it for us to buy. I couldn't endorse it at the new price. Who else is like that? IMAX was like that too. I remember iRobot. iRobot went flying higher, like tripled or something in price, and we just let it go. You have to, because I said it's not worth this. I'd almost short it at this point. It gets to that point where you almost short something. Now we have more advanced traders in our site, and they tend to with the advanced strategies and people who have large portfolios. Sometimes we'll do something even trickier, which is we'll sell the underlying and not sell the calls. So now we got naked calls, and we might cover it with a longer spread to cover it just in case it really does go any higher. But generally, I'm pretty good at these things. So, we kind of call the top, and then we wait for it to come back down. It calms back down. Now we've made a lot more money than we would have otherwise. So you just have to take every situation in hand and value it properly. And I'll tell you the greatest thing about hedging, though. Oh, I know. Mark was talking about this before, and this is really important. As a rule of thumb, we put anywhere from 20% to 35% of our unrealized gains into hedging. And that's how you lock it in your portfolio. And then when something like last week happened or last month happened and the market's dropping, we're all laughing our asses off because our short-term portfolio, which is where we keep our hedges, is piling up cash. The long-term positions are only barely getting down to the point where we wanted to buy them anyway. And we just play for the bounce. And then we've got all this cash to start pouring into adding to these positions. But that's because we have the discipline of always putting in. What's it going to do, though? It's going to obviously cap your long, you're going to take off 15, 20% of your gains going up. You're going to lose it, but that's okay. It's 15, 20% of your gains. You're not losing your gains. You're locking them in. I'm sorry. Are we over time? We are done. All right. Thank you very much, everybody. Oh, gotta go with these steps. Well, why do they get more time?
To everyone for coming to this. Really appreciate it. I know you took time out of your schedules, and airfare is not cheap. I mean, nothing right now about traveling is cheap. So it means a lot to all of us that you came. I'm sure the sponsors are very grateful as well. Round of applause for the speakers and sponsors. And Benzinga. I mentioned yesterday that I found most of the sponsors. I found the hotel, and then they basically did everything else. So they really did a phenomenal job. All the logistics, the signage, getting the menu straight, the audio-visual stuff straight. Putting these things on is a lot of work behind the scenes that I never could have done by myself. So I'm grateful they came in and helped me out. Some people have asked if we're going to do another one. I don't know yet. I just have to take a few months to digest this one, and we'll send out some surveys and get some feedback from people, see what we can do better next time. Gav, anything else you want to say? Oh, recordings. So if you go to Benzinga's YouTube page, you can already find yesterday's recordings on there. And then today's recordings will probably be on there sometime tomorrow. But we'll also blast those out to everyone since we have your emails. You'll also probably get some emails from the sponsors for some free trials and whatnot. What else? Yeah. Oh, and a round of applause for Gav for being a great MC this week.
Yeah, the only other thing I'd say is if you want to just keep in touch with more conferences, if there's going to be another conference, if you want to see all the videos from this, everything's on Twitter as well at FinTwit, CONF. So it's just FinTwitConf. That's where you can find all the details. You'll see videos of past speakers, all that type of stuff and all that information. And then for this evening, I know that there's still a good amount of groups that are going to be around. I'm sure if you're downstairs in the lobby at the Aria, there's going to be a group of people at some different tables. So feel free to join in. If there's somebody that you saw during this, perhaps you don't recognize them, just walk up, say you were part of the conference, make some friends. It's going to be a good time in the evening. And then to everybody that's headed out tomorrow, safe travels.
Absolutely. Thank you, everybody.